Imagine two people earning exactly the same salary for the next 20 years. One retires wealthy, while the other is still worried about paying the bills. The difference isn't luck, a higher income, or finding the next Bitcoin before everyone else. It's the decisions they make with their money every single day. Most people spend years chasing quick profits, believing that one great investment will change everything. But history tells a very different story. The greatest fortunes weren't built overnight. They were built patiently, through simple decisions repeated over and over again. No one understood that better than Warren Buffett. While the world chased trends and easy money, he quietly followed a set of principles that worked through recessions, market crashes, and economic booms alike. In this audiobook, you'll discover those timeless principles and learn why building lasting wealth has far less to do with luck than with the habits you build today. Stay until the end, because one lesson from Warren Buffett could change the way you think about money for the rest of your life. And before we continue, don't forget to subscribe to the channel so you don't miss new audiobooks. And now, let's begin.
Introduction. Warren Buffett is a man who bought his first shares with pocket money at the age of 11, became a millionaire by 30, and by 90 had become one of the wealthiest people in human history, with a fortune exceeding $100 billion. No inheritance, no connections, no lucky break. Just clear thinking, iron discipline, and a handful of simple principles he followed throughout his life. His story is unlike those of other billionaires. He did not build revolutionary technologies. He did not stake everything on a single bet. He was not a mathematical or programming prodigy. Buffett simply saw the world differently from most people. He saw value where others saw only price. He stayed calm where others surrendered to panic. He thought in decades where others thought in quarters. That is what made him a legend. For 70 years he has shared his principles openly, in the famous shareholder letters of Berkshire Hathaway, in interviews, in public speeches, and in short but memorable observations that have traveled around the world. His wisdom has always been in plain sight. The paradox is that most people have never been able to put it to use, not because it is complex, but because it is scattered across thousands of pages, dozens of sources, and 7 decades of public life. You too can build your financial well-being. But reading all his letters, studying hundreds of interviews, mastering the details of fundamental analysis, and tracking every move at Berkshire Hathaway is a long road that requires time most of us simply don't have. We have done that work for you, distilling the 30 most powerful principles of Warren Buffett, the core ideas behind everything he has achieved. Not abstract theory, but concrete rules you can apply in your own life today. By following them, you will learn to think like an investor, protect your money from sudden mistakes, start building capital from whatever sum you have, and steadily work toward the financial freedom you are aiming for. One thing is worth understanding from the outset. Buffett's rules are not only about the stock market. Behind each financial principle lies a broader philosophy about patience, honesty, reputation, and the value of lifelong learning. That is why they work for everyone, regardless of age, income, or experience. It doesn't matter whether you have $100 right now or 100,000. What matters is the mindset you bring to money and to life. These 30 rules distill everything Buffett has taught throughout his career. Start with one. Apply it today. Your path to lasting wealth begins here. Part 1. Money and investing for everyone. Rule 1. Buy what you understand. Never invest blind. The rule: only put money into businesses and assets you can explain in plain language. To a child, a friend, a neighbor. If you cannot explain how a company makes money, what drives its profits, and why customers keep coming back, you are not investing. You are making a blind bet. Why it works. Imagine buying a car with the hood permanently welded shut. The salesman tells you it's a great vehicle. Everyone's buying one. The price is about to jump and you'd better hurry. You pay, get in, and drive off. Then the car breaks down in the middle of the road. You have no idea why, no idea what failed, no idea whether to pay for repairs or cut your losses right there. That is exactly what investing in something you don't understand looks like. The money is gone, and you're left with nothing but confusion and anxiety. Understanding is not merely psychological comfort. It is your primary financial protection. When you genuinely know how a business works, you understand why its stock rises and why it may temporarily fall. You can distinguish ordinary market volatility from a real problem inside the company. You make decisions based on logic and facts, not on fear, greed, or advice from strangers on social media. That difference is what separates a true investor from a casino player. Understanding also gives you something genuinely priceless: confidence in difficult moments. When the market collapses and everyone around you is gripped by panic, the person who deeply understands the business they own keeps a clear head. They hold their position calmly, or even buy additional shares at an attractive price, because they know the company's fundamentals haven't changed. Only the crowd's mood has. The calm and clarity are worth far more than any tip from a broker. What to do and how to apply it. 1. Before putting money into any asset, write down 3 simple sentences: what exactly this company does, how it makes money, and why customers will continue paying for it in the future. If you can't do this, don't invest. This rule has no exceptions. 2. Use the products and services of companies you invest in. Do you use this bank? Shop at this store every week? Can't imagine your day without this app. Personal consumer experience is the first and most honest source of genuine business understanding. 3. Read annual company reports, especially the letter from management to shareholders. You don't need to be a professional accountant. Good executives write simply, honestly, and to the point. If a report is full of vague language, complex jargon, and evasive phrasing, treat that as a warning signal. 4. Ask yourself, could I explain this investment to an elderly relative in a way that makes them understand and agree it's sensible? If not, either you haven't fully understood it yourself, or the product is too complex to evaluate. Either way, hold back and keep studying. 5. Start with simple, transparent industries. Retail, banking, insurance, food production, everyday consumer goods. These sectors operate on clear, stable principles that are easy to grasp. Over time, you will naturally expand your circle of competence, and with it, discover new opportunities. 6. Never confuse name recognition with business understanding. Hearing about a company in the news or seeing its advertisement on television does not make you an expert in its operations. Real understanding comes from study, not surface familiarity. Common mistake: people frequently confuse a lively interest in a company with genuine understanding of its business. They read exciting news, follow the stock price, discuss prospects with colleagues, and at some point begin to feel like real experts. This is a dangerous trap. Interest is merely a starting point. It is not understanding itself. The honest test is simple. Can I explain this company's business model right now, without looking anything up, in under 2 minutes? If not, you are not yet ready to invest there. The best opportunities won't disappear, but lost capital is far harder to recover. Result: when you invest only in what you truly understand, you stop being a player dependent on other people's opinions and random luck, and become a conscious business owner, confident, calm, and ready for whatever the market brings. Rule 2. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. The rule: before thinking about how much you might earn on any investment, stop and think about how much you might lose. Protecting capital is not the caution of a coward, nor a sign of absent ambition. It is the foundational wisdom that separates a genuine investor from a gambler staking everything on a single card. Why it works. The mathematics of loss is harsh and unforgiving, and that is precisely why this rule sits at the center of sound financial thinking. Look at the numbers clearly. If you lose 10% of your capital, you need to earn slightly more than 11% to get back to where you started. If you lose 25%, you need to earn 33%. If you lose 50%, you must double your remaining capital, earn 100% just to break even. And that represents time, energy, and missed opportunities that could have been working towards your growth. Every year spent recovering is a year lost to building. There is another consequence of losses that is rarely discussed openly, but equally destructive: the psychological damage. When you lose a significant portion of your capital, fear paralyzes you precisely at the moment when bold, decisive action is needed. You begin to avoid investing altogether. You miss the best opportunities exactly when they appear, and you make erratic, emotional decisions instead of considered ones. Preserved capital is not just money in an account. It is preserved confidence, clarity of thought, and the ability to act rationally even in the most turbulent market conditions. What to do and how to apply it. 1. Before every investment, ask yourself not one but two questions. The first, familiar one: how much can I earn here? The second, and more important one: how much can I lose in the worst-case scenario? If the answer to the second question worries you more than the answer to the first excites you, decline the deal without regret. The balance of risk and reward must always work in your favor. 2. Never invest money you cannot afford to lose entirely. Investment capital is only what remains after building a solid financial cushion, covering all current obligations and setting aside several months of living expenses. Money invested under financial pressure or emotional stress is almost always lost. 3. Avoid borrowed money for investments in risky assets. Leverage amplifies not only potential profits, but real losses in equal measure. When the market moves against you, the debt continues to grow, regardless of what is happening to your portfolio. It is a trap from which escaping without serious damage is extremely difficult. 4. Diversify across different assets, sectors, and geographic markets. This is not merely standard textbook advice. It is direct, practical protection for your capital. If one position collapses entirely, the others continue working and generating income. No asset, however attractive it may appear, deserves everything you have. 5. Set a clear personal loss limit for each position before you invest, not after the situation has begun to deteriorate. This decision must be made with a clear head, in a calm environment, not in a moment when emotions have taken over. 6. Regularly review your portfolio and honestly answer one simple question: would I buy this asset today, knowing everything I now know about it? If the answer is no, that is a clear signal to reconsider the position while the losses are still small and manageable. Common mistake, the most widespread and destructive mistake, is chasing high returns at the expense of sensible reliability. People see a promise of 30, 50, or 100% annual returns, and critical thinking switches off immediately. They forget to ask the simplest question: what lies behind that number? What specific risk does it carry? Why does this asset offer such high returns when reliable, proven instruments offer far less? The answer is always the same. A high promised return is almost always a direct signal of high hidden risk. The investor who remembers this consistently preserves and grows capital. The investor who forgets it, even once, often loses everything and has to start from zero. Result: real wealth is built not on spectacular victories and reckless adventures, but on the consistent absence of catastrophic defeats. Protect what you already have, and time will do the rest. Rule 3. Think long-term. Wealth is built over years, not days. The rule: True financial wealth is not born from quick deals and lucky speculation, but from patient, consistent, long-term thinking. The person who thinks in decades will always outpace the person who thinks in quarters, not because they are smarter or luckier, but because time itself works for them, without pause. Why it works? There is a paradox at the heart of investing that runs against our intuition. Most people believe that the more actively they act, the more they earn. The more frequently they buy and sell, the better the result. The more closely they monitor prices every day, the more timely their decisions. But reality works in exactly the opposite way. Studies consistently show that investors who buy quality assets and hold them patiently for years almost always outperform active traders. There are several reasons for this, and each carries real weight. First, the long-term investor avoids the transaction costs, taxes, and brokerage commissions that quietly but relentlessly erode a significant portion of active traders' profits with every trade. Second, they are not driven by short-term market emotions, panic during a crash, euphoria at the peak of a rally, the fear of missing out, and therefore make more considered, rational decisions. Third, and most importantly, the long-term investor allows compound interest to operate at full force. Compound interest is the mechanism by which your profit begins to generate its own profit. Over time, this effect becomes almost unbelievable in scale. And it is this mechanism that transforms modest, regular investments into significant wealth. Long-term thinking is a rare competitive advantage, precisely because most people find it so difficult. We live in a world of instant results, short videos, and real-time notifications. Waiting 10 or 20 years feels impossible and unreasonable. But that willingness to wait is exactly what distinguishes those who ultimately achieve financial independence from those who forever chase quick profits and repeatedly end up with nothing. What to do and how to apply it. Set a minimum holding horizon for each investment, no less than 5 years. If you are not prepared to hold an asset for 5 years, don't hold it for 5 minutes. This simple filter automatically screens out speculative and emotional decisions before they can cause real damage. Stop checking your portfolio every day. Daily price movements carry no useful information for the long-term investor. They only create anxiety and provoke impulsive decisions. Reviewing your portfolio once a quarter or even once every 6 months is entirely sufficient. Draw up a personal financial plan with a clear horizon of 10, 15, and 20 years. Write down specific figures, what capital you want to have in 10 years, what in 20, and how much you need to set aside and invest each month to reach those goals. A concrete long-term target helps you stay on course during market turbulence and moments of personal doubt. Reinvest all dividends and earned profits back into the portfolio rather than spending them. Systematic reinvestment is what unleashes the full power of compound interest. Every pound reinvested today is worth several pounds in 10 years and a great deal more in 20. Ignore financial news that manufactures urgency and demands immediate action. The market will always offer reasons for panic or euphoria. Your task is to remain committed to the long-term plan, regardless of the noise around you. Study long-term market charts spanning the past 100 years and read biographies of great investors. This is a powerful antidote to short-term thinking. When you see how the market recovered after every historical crisis and continued to grow, the fear of temporary downturns loses much of its grip. Common mistake. People abandon long-term strategies precisely at the moment when those strategies are beginning to deliver results. The market falls, and patience evaporates instantly. A new hot asset appears promising quick profits, and the long-term plan is quietly forgotten. This is the most costly mistake in investing. Interrupting the force of compound interest halfway through is like planting a tree, tending it for 10 years, and then cutting it down before it bears fruit. Long-term thinking requires not genius, but strength of character. And in the end, it is character that determines the financial outcome. Result: time is the most powerful and most accessible tool in any investor's arsenal. Give your money enough time, and it will accomplish what no short-term trading ever can.
Now, take a moment to think about it. Have you ever experienced something similar in your own life? If this feels familiar to you, write the word familiar in the comments.
Rule 4. Compound interest. The eighth wonder of the world. Use it. The rule: allow your money to earn money, then allow that new money to earn still more. Compound interest is the mechanism by which every pound you earn immediately begins working alongside the capital you originally invested. The longer this process runs uninterrupted, the more extraordinary the results become. Why it works. Imagine a small snowball rolling from the top of a long snow-covered slope. At the very beginning it looks tiny and moves slowly, but as it travels downward it gathers more and more snow, grows heavier, picks up speed, and by the time it reaches the bottom it has become a massive, unstoppable avalanche. That is exactly how compound interest works on your capital. In the early years, the growth seems modest and almost imperceptible. But a turning point arrives when the accumulated mass of capital begins growing at a pace that astonishes even those who fully understand the mathematics. The concrete figures speak for themselves. £10,000 invested at 10% per year becomes £26,000 in 10 years. In 20 years, £67,000. In 30 years, £174,000. In 40 years, £453,000. The same original sum, the same rate, one essential condition: don't interrupt the process. Now imagine that instead of investing £10,000 once, you added new amounts every month throughout all those years. The result after 30 or 40 years becomes truly staggering. The essential condition without which compound interest does not work is time and continuity. You cannot withdraw profits. You cannot interrupt the process during moments of fear or temptation. This is precisely why starting as early as possible is not merely good advice. It is a mathematical necessity. A person who starts saving at 20 will have far more by 60 than someone who started at 30 with the same amount and the same rate of return. The difference is only 10 years. But in the world of compound interest, those 10 years are worth an entire fortune. What to do and how to apply it. 1. Start today with whatever sum is available to you. Don't wait for a significant starting capital to accumulate. Even modest amounts invested today will, in 20 or 30 years, become something substantial. Delaying even by 1 year costs you far more than it appears at first glance. 2. Never withdraw profit from your investment portfolio without pressing necessity. Every time you take out money you have earned, you break the chain of compound interest and shortchange your future self. Let the profits stay and keep working. 3. Automate contributions to your investment account. Set up an automatic transfer on the day you receive your salary, before the money reaches your current account. Regular top-ups multiply the effect of compound interest and remove the need for a separate act of willpower each time. 4. Choose instruments with income reinvestment as the default option. Dividend stocks with automatic reinvestment, savings accounts with daily compounding, funds with reinvestment of distributions. All of them work for you around the clock while you go about your ordinary life. 5. Use the rule of 72. Divide 72 by the annual return on your investment, and you get the approximate number of years it will take your capital to double. At 10% per year, capital doubles roughly every 7 years. It is a simple, vivid way to understand the real power of the tool already in your hands. 6. Visualize your financial future using real figures. Find an online compound interest calculator, enter your own data, and look carefully at the graph at 20 and 30 years. That picture has the power to permanently change your relationship with money. Common mistake. People consistently underestimate compound interest at the beginning and are only astonished by it at the end, by which point it is too late to make the most of it. They delay starting to invest, waiting for the right moment or a large enough sum. They withdraw profits at the first opportunity, treating them as a well-earned reward. They interrupt the process during market downturns, locking in losses at exactly the moment when staying put matters most. Each of these actions causes damage that is invisible in the moment, but colossal years later. The governing principle is simple. Once you have started the mechanism, don't touch it. Result: compound interest requires no special talent, useful connections, or lucky breaks. It requires only one thing: start today and don't stop. Give it enough time and it will do all the work for you. Rule 5. Price and value are different things. Learn to tell them apart. The rule. Price is what you pay at a specific moment in the market. Value is what you receive over the long term. These two things may fully coincide, or they may diverge radically. The investor who has learned to see the difference gains a lasting advantage over the majority of market participants, who simply react to price tags rather than the real worth behind them. Why it works. The market is not a precise, impartial instrument for measuring the value of assets. It is a living mechanism that daily reflects the moods of the crowd, the collective fears, hopes, expectations, and emotions of millions of people at a given moment. This is precisely why the market regularly, and sometimes very significantly, misprices assets in both directions. Sometimes it sells excellent, resilient companies at bargain prices because everyone is frightened and wants to get out at any cost. Sometimes it offers quite ordinary businesses at sky-high prices because everyone is caught up in euphoria and willing to pay anything to be part of the boom. The gap between price and value is precisely where genuine investment profit is born. When you buy an asset whose real value is significantly above the current market price, you create what experienced investors call a margin of safety, a reliable buffer that protects your capital even if your calculations prove slightly optimistic or circumstances change. It is the existence of this margin of safety that transforms investing from a gamble into a controlled, predictable process of building long-term capital. One thing is worth understanding clearly: a high price does not in itself mean high value, and a low price does not automatically mean a bargain. A weak company at a low price is still a weak company that will continue losing value. A great company at a reasonable price is one of the best assets you can find in the market. The ability to tell one from the other is the true heart of the art of investing. What to do and how to apply it. 1. Before looking at the market price of a stock, ask yourself the key question: what is this business actually worth? Try to assess the company yourself, based on its earnings, growth rates, competitive advantages, and quality of management. Only then compare your estimate with what the market is currently offering. 2. Study the price-to-earnings ratio and other basic valuation multiples. These tools allow you to quickly gauge whether the market is pricing a company fairly, significantly overpaying, or offering it at a meaningful discount. They don't provide precise answers to every question, but they point you in the right direction, which most investors never bother to look. 3. Build a personal watch list of quality companies you understand well and would like to own, and determine for each the specific price at which a purchase would be genuinely attractive. Then wait. The market will inevitably provide such an opportunity during corrections, crises, or periods of general pessimism. 4. Never buy an asset simply because it has fallen sharply in price. A steep drop is not automatic proof that value has appeared. First confirm that the company's fundamental indicators remain strong, and only then consider the purchase. Cheap and valuable are not the same thing. 5. Be especially cautious with assets trading at very high prices relative to earnings. A high price already reflects extremely optimistic expectations of future growth. If reality turns out even slightly worse than those expectations, the price will fall sharply, even if the business itself continues to operate normally. 6. Develop the habit of assessing price against value in every area of life, not only in investments. An expensive restaurant, a fashionable phone, a prestigious address, ask yourself, am I paying for real value or for the illusion of status and the fashion of the moment? This way of thinking will, over time, reshape your financial habits in ways that matter. Common mistake. People treat the market price as the objective truth about the value of an asset. If a stock has risen, the company has improved. If it has fallen, it has gotten worse. This is a deep and costly misconception. The market price reflects only the current collective mood, which changes daily and is often entirely irrational. The investor who has learned to think independently of the crowd and to assess a business by its real characteristics gains access to opportunities that most market participants simply never see. Result: the market regularly offers you the chance to buy a pound's worth of value for 50 pence, but only if you know how to see the difference between price and value. Develop this skill, and the market will transform from a source of anxiety into an enduring source of opportunity. Part 2. Psychology and Emotions. Rule 6. Be greedy when others are fearful, and cautious when others are greedy. The rule: when the market is gripped by panic and everyone around you is selling out of fear, that is when the best buying opportunities arrive. When the market is at peak euphoria and everyone is piling in expecting easy profits, that is when maximum caution is required. Act deliberately against the crowd, not with it, and you will consistently find yourself on the right side of financial history. Why it works. The crowd almost always gets it wrong at the extremes of the market cycle. Not because people are foolish, but because human psychology is wired this way. When everyone around you is selling and talking about impending catastrophe, your brain registers it as a signal of real danger and demands that you run with the rest. When everyone is buying and breathlessly describing enormous profits, your brain feels an overwhelming fear of missing out and pushes you to buy at any price, even an irrational one. Both reactions are entirely natural from a biological standpoint and entirely destructive from the standpoint of long-term financial results. Financial history confirms the same pattern again and again. The best buying opportunities arise when sentiment is at its bleakest. The financial crisis of 2008, the market collapse at the onset of the pandemic in 2020, the Asian crisis of 1997. Each episode looked like the end of the world to most market participants, and each one proved a remarkable opportunity for the few who kept a clear head and acted against the prevailing panic. Those who bought in the darkest moments built fortunes. Those who sold in panic locked in their losses and missed the recovery that followed. The other side of this rule matters just as much. When the market is at all-time highs, when everyone talks about endless growth, when people who have never shown any interest in investing are hotly discussing stocks over dinner, that is an unmistakable sign of serious overheating. In such moments, the right move is not to buy with redoubled enthusiasm, but to methodically reduce risk, review the portfolio, and build a cash reserve for the opportunities that will eventually follow. What to do and how to apply it. 1. Build and regularly update a personal watch list of companies you would want to buy at the right price. During market panics, you need to act quickly and with conviction, and for that, the list must be ready before any crisis begins. Those who prepare in advance make full use of opportunities. Those who start thinking in the middle of a panic are paralyzed by fear. 2. Maintain a permanent cash reserve specifically for buying during market downturns. This reserve is not dead weight in the portfolio. It is the investor's ready weapon, waiting patiently for its moment. Having available capital in a crisis is precisely what separates those who profit from panic from those who suffer through it. 3. Set yourself a clear rule. When the market falls more than 20%, begin systematically adding to quality positions. Don't try to call the exact bottom. Even the best professionals can't do that. Simply buy regularly and methodically while others are selling. 4. Learn to spot the signs of market euphoria in everyday life. When taxi drivers start offering stock tips, when neighbors boast about their investment gains, when financial news announces new records every day, that is a clear signal to reduce risk, not to increase exposure. 5. Never make investment decisions under the influence of emotionally charged headlines. Financial media run on the fear and greed of their audience. Their goal is not to help you make money. It is to hold your attention by any means necessary. The louder the headline, the more carefully you should evaluate what it actually says. 6. Keep a personal journal of your emotional states as an investor. When you feel frightened and want to sell everything, that is usually when you should be buying. When everything seems wonderful and you want to buy even more, that is when you should pause and take stock of the situation honestly. Common mistake. People know this rule well and still fail to follow it when it matters most. Acting deliberately against the crowd is extraordinarily difficult in practice. In a moment of panic, every piece of news confirms that things are terrible. Every acquaintance is talking about losses. Every instinct says, get out now. Overcoming all of that requires not just knowledge, but iron discipline built well in advance. Clear rules you follow regardless of how you feel in the heat of the moment. Result. The greatest fortunes in investing have been built during periods of widespread fear and despair. Learn to stay calm and think clearly when others are panicking, and the market will reward you generously again and again for as long as you invest. Rule 7. Emotions are the enemy of sound decisions. Never decide under their influence. The rule: financial decisions made under the influence of fear, greed, euphoria, or despair are almost always wrong and often costly. Separate emotion from analytical thinking, and the quality of your investment decisions will improve immediately and substantially. Investing demands cold calculation and clarity of thought, not hot, fleeting feelings. Why it works. The human brain was not built for investing. It was built for survival, where an instant response to a threat could save your life. When a predator lunged at our ancestors, there was no time for careful analysis. Flight had to be immediate and instinctive. That same ancient program still fires every time we watch our portfolio rapidly losing value. The brain perceives a market decline as a direct threat and issues a command. Sell, run, save yourself now. The result is that people sell quality assets right at the market bottom, precisely the moment when rational thinking demands buying. Greed works just as destructively, only in the opposite direction. When the market is rising and everyone around you seems to be making money effortlessly, the brain switches into a mode of acute fear of missing out. Rational analysis shuts off without warning. People buy clearly overvalued assets at the peak of the market, exactly when the situation calls for maximum caution. Fear and greed are the two poles of emotional investing, and both lead to the same outcome: buying high and selling low. That is the direct opposite of what long-term wealth building requires. Professional investors differ from amateurs not in that they feel no emotions, they feel them just as fully. The difference is that they have developed a system of clear rules and genuine discipline that prevents emotions from dictating their financial decisions. They act on the basis of facts, concrete numbers, and pre-established criteria, not on the basis of how they feel during a moment of market turbulence. What to do and how to apply it. 1. Never make important financial decisions in a moment of acute emotional reaction. Establish a personal rule, a minimum of 24 hours between the first impulse to act and the action itself. During that time, the initial emotion will inevitably weaken and give way to a calmer, more measured read of the situation. 2. Write down the reasons for each investment at the moment you make it. Record the specific facts and logic behind your decision. When the market puts you under emotional pressure in the future, you can return to those notes and ask yourself honestly, have the fundamentals changed, or has only my current mood and anxiety level changed? 3. Create a personal investment document with clear criteria for buying and selling each asset in your portfolio. Follow those criteria strictly, regardless of what the market is doing. Rules written in advance are the voice of your rational mind at its clearest. Trust that voice over your emotions in the heat of a panic. 4. Reduce how often you check your portfolio to the minimum necessary. The more frequently you look at the numbers, the more emotional impulses accumulate. For the long-term investor, reviewing the portfolio once a quarter is entirely sufficient. Daily monitoring does not improve returns. It creates chronic anxiety and provokes unnecessary action. 5. Find a trusted partner or mentor with whom you can talk through investment ideas before making final decisions. Simply explaining your thinking out loud to another person significantly reduces emotional intensity and helps you see the situation more objectively. A good sounding board will ask the right questions and help prevent an impulsive, costly decision. 6. Regularly study your own history of emotional decisions. Recall specific moments when you acted out of fear or greed, and honestly evaluate the outcomes. That personal record of mistakes is the most powerful antidote to repeating the same patterns. Painful personal experience is more persuasive than any theory. Common mistake. People convince themselves that their emotional decisions are in fact valuable intuition. They reframe fear as wise caution and greed as justified confidence in their own analysis. This is the most dangerous form of self-deception in investing. Real investment intuition is built from years of deep experience and serious study of markets. An emotional impulse is simply the nervous system's reaction to short-term events. It has nothing to do with a genuine assessment of long-term value. Learn to tell the two apart honestly, and you will have taken a significant step toward genuine financial independence. Result: the investor who has learned to manage their emotions gains a durable competitive advantage over the majority of market participants. A cool head in the most anxious moments is the true foundation of long-term investment success. Rule 8. Patience is your greatest advantage over the professionals. The rule: professional fund managers have expensive analysts, powerful computers, and access to information most investors will never see. But you have something they don't: the complete freedom to wait for as long as necessary. Patience is the one decisive advantage a private investor holds over a Wall Street professional, and it can outweigh everything else, on the single condition that you actually use it. Why it works: professional fund managers operate under constant, relentless pressure to deliver short-term results. They are evaluated quarterly, without exception. Their clients want visible returns now, not in 10 years. Their careers and reputations depend directly on how the numbers look at the end of each reporting period. This forces them into decisions driven not by the logic of long-term value, but by the need to look good in the next quarter. They simply cannot afford to sit and wait, even when waiting is the only sensible course of action. You are in a fundamentally different and far more advantageous position. You answer to no one. Nobody evaluates your results every 3 months or threatens your job. You can hold an excellent asset for 3, 5, or 10 years, for exactly as long as it takes for its full potential to be realized. You can go years without making a single transaction if no good opportunities exist. This is a freedom that virtually all professional market participants lack, and yet most private investors fail to use it. They imitate the frenetic activity of professionals, even though they are under no obligation to do so. Patience in investing has two important dimensions. The first is patience in holding a position. The ability to keep a quality asset for years without giving in to the temptation to take profits too early or panicking at a temporary price drop. The second is patience in waiting for an opportunity. The ability to sit on cash without deploying it into mediocre assets simply because money should be working, and to wait calmly for a genuinely attractive moment to buy. Both forms of patience are equally valuable and equally rare. What to do and how to apply it. 1. Accept as a given. Doing nothing is a fully valid investment strategy. Not every day, month, or year brings genuinely good opportunities. Don't trade for the sake of feeling active. Every unnecessary transaction costs real money in commissions, taxes, and lost compounding time. 2. Set a personal minimum attractiveness threshold for any investment. Buy only when an asset clearly meets your criteria for value and quality. If no such opportunities exist right now, simply wait. The market cyclically creates excellent buying moments, and your job is to be ready for them, rather than filling the portfolio with whatever happens to be available today. 3. When you make an investment, write down your estimate of how long the business will need to realize its full potential. That note becomes a reliable anchor when market noise tempts you to sell before the time is right. 4. Track and analyze both the trades you passed on out of patience and the ones you made too hastily. Compare the outcomes in real terms. This simple exercise will demonstrate the value of patience more vividly than any book on investing. 5. Build a personal ritual before every transaction. Ask yourself 3 questions. Do I really need to act right now? What changes if I wait another 3 months? And am I being driven by fear of missing out? If honest answers don't provide a compelling case for acting immediately, wait. 6. Read the biographies of great long-term investors and study their actual portfolios. You will find that outstanding results were achieved not through active trading, but through long-term holding of a small number of well-chosen positions over many years. Common mistake. People confuse activity with effectiveness. If they're not making transactions, they feel they're missing opportunities and being passive. In reality, it is active trading without sound justification that is the chief enemy of long-term returns. Every unnecessary trade is not a sign of professionalism. It is a direct cost of impatience. The market does not reward busyness. It consistently rewards discipline and composure. Result: patience is not passivity, and it is not the absence of strategy. It is an active, deliberate choice to wait for the right moment and hold the right asset for exactly as long as necessary. That is precisely what turns an ordinary investor into an outstanding one. Rule 9. Don't try to time the market. Nobody knows what tomorrow holds. The rule: there is not a single person on earth, not the most experienced analyst, not the most celebrated economist, not the wealthiest investor, who can reliably and consistently predict market movements. Attempts to guess the ideal moment to enter and exit positions are not only futile but dangerous. They create the illusion of control where none exists, and force costly decisions based on guesswork rather than facts. Why it works? Every year, thousands of analysts, economists, and market strategists publish confident forecasts about where the market is heading. They do so with authority, complex charts, and persuasive arguments. And every year, reality refutes the overwhelming majority of those forecasts. Study after study confirms that the results of professional forecasters are, on average, no better than random guessing. The market is simply too complex, too dependent on millions of unpredictable factors: political decisions, technological breakthroughs, natural disasters, unexpected shifts in consumer behavior, for its movements to be reliably predicted on any consistent basis. Here is what typically happens to investors who try to time the market. They wait for the perfect moment to buy, and the market rises steadily without them. They sell in anticipation of an inevitable fall, and the market continues upward for another year. Then, convinced they were wrong and tired of waiting, they buy near the peak. And that is precisely when the market begins to decline. This painful and costly cycle repeats itself again and again, each time extracting a higher price. The data is consistent. Private investors who actively try to time the market earn, on average, significantly lower returns than those who simply invest regularly and hold quality assets. It is worth understanding the distinction between two very different activities. Analyzing whether a specific company is worth its current price, that is reasonable, sound, and productive. Trying to predict whether the market as a whole will rise or fall over the next 3 months, that is speculation, and it has nothing to do with genuine investing. Focus on the first and abandon the second entirely. What to do and how to apply it. 1. Stop trying to find the perfect moment to buy. Instead, invest fixed amounts at regular intervals, regardless of current market conditions. This approach automatically averages your purchase price. You buy fewer shares when they are expensive and more when they are cheap. It is simple, well proven, and requires no forecasting. 2. When you hear another confident market prediction, ask yourself a straightforward question. If this person truly knows where the market is going, why are they telling us on television rather than quietly making billions? That question tends to restore perspective immediately. 3. Keep a personal record of your market predictions over the course of a year. Write down every forecast you make about market direction, then check how accurate it proved to be. Seeing your own track record in black and white is more convincing than any theory. 4. Shift your focus entirely from where is the market going to which specific business is creating real long-term value right now. The first question has no reliable answer. The second does, and it is the one that leads to consistent results over time. 5. Remember, missing just a handful of the market's best trading days because you were sitting on the sidelines waiting for the right moment costs an enormous amount of money over the long run. Investors who missed the 20 best trading days of the past 2 decades earned returns many times lower than those who stayed invested throughout. Being in the market matters more than any timing. 6. Build and follow a long-term investment plan that requires no market forecasts. Regular contributions, broad diversification, and a long holding horizon. These 3 elements consistently deliver results that attempts to time the market simply cannot match. Common mistake. People see patterns where none exist and interpret chance coincidences as evidence of their ability to predict markets. One lucky forecast creates dangerous and wholly unwarranted confidence. That confidence leads to ever larger bets based on assumptions, and sooner or later, serious losses follow. Random luck and consistent skill are fundamentally different things, and the market ultimately makes that distinction clear. Result: time spent in the market is always more valuable than endless attempts to find the perfect entry point. Invest regularly, hold quality assets for the long term, and let the market do the rest. Rule 10. Risk is not price volatility, it is not knowing what you are doing. The rule. Most people think of a falling portfolio as the primary investment risk. That is a deep and costly misconception. The real risk is putting money into something you don't understand. When you genuinely know the business you have invested in, a temporary drop in its market price is not a risk. It is an opportunity. When you don't understand what you own, any price movement becomes a source of danger, panic, and seriously wrong decisions. Why it works. Imagine 2 investors who bought shares in the same company at the same price on the same day. A year later, the shares are down 30%. The first investor studied the business carefully. They understand what the company earns. They know the specific reasons for the temporary price decline. And they are confident that its fundamental indicators remain sound. For them, the drop is a discount on a quality asset, and they calmly add to their position at the better price. The second investor bought the same shares on a friend's tip, knowing nothing about the underlying business. For them, a 30% fall is a genuine catastrophe. They don't know whether to hold or sell. They panic, and they ultimately sell at the bottom, locking in the maximum possible loss. The same situation, entirely opposite outcomes. Everything turns on not the movement of the price, but the depth of understanding of what is actually happening with the real business. Volatility is simply the temporary fluctuation of market sentiment. Over the long term, it is entirely manageable, and it causes no lasting financial harm to the investor who knows exactly what they own and why they own it. The real risk is acting in a state of ignorance, being unable to distinguish a company's temporary setback from a fundamental, unresolvable problem. That is precisely why experienced investors ride out market storms with a calm that bewilders beginners. They have no special gift of foresight and no idea exactly when the market will recover. But they know what matters most. The business they own continues to create real value regardless of what the screen shows at any given moment. That knowledge is the most reliable protection against genuine investment risk. What to do and how to apply it. 1. Before every investment, honestly rate your understanding of the business on a scale of 1 to 10. If your rating is below 7, don't invest until you have studied it thoroughly. The principle is straightforward. The deeper your understanding of a business, the lower your real investment risk, regardless of how its share price behaves. 2. Learn to clearly distinguish between two very different events, a change in the market price of an asset and a change in the actual quality of the business itself. Prices move every day for 1,000 reasons, most of which have nothing to do with how well the company is actually performing. Follow the business first, not the exchange price. 3. For each position in your portfolio, maintain a short list of 5 to 7 key indicators that genuinely reflect the health of the business: revenue, profitability, market share, management quality, competitive advantages. Review these regularly, not the daily price fluctuations. 4. When the price of an asset drops sharply, the first question to ask is the essential one. Has anything changed in the fundamental indicators of the business, or has only the market's mood shifted? If the underlying business remains solid, this is not a risk, but an opportunity to buy more at a better price. If the fundamentals have genuinely deteriorated, that is a serious signal to reconsider the position. 5. Never invest significant capital in assets you bought purely because someone else believes they should go up. Another person's conviction does not protect your capital. Only your own genuine understanding of the business provides real protection when markets get difficult. 6. Continuously raise your level of financial literacy and sector knowledge. Every business book you read, every annual report you study, reduces your real investment risk more effectively than any mechanical diversification strategy or stop-loss order. Common mistake. People assess portfolio risk almost exclusively through the lens of volatility, how sharply and frequently prices move. They flee volatile assets in favor of stable ones, without realizing that a stable price in a weak, deteriorating business is far more dangerous than a volatile but fundamentally strong one. Volatility is unsettling, but it does not in itself destroy capital. Ignorance is not unsettling, but it destroys capital systematically, inevitably, and often irreversibly. Confusing these two very different things is one of the most expensive mistakes a private investor can make. Result: reduce real risk through the one truly reliable method. Study everything you invest in, deeply and honestly. Knowledge protects capital better than any financial instrument or hedging strategy. Part 3. The life philosophy of money. Rule 11. Live below your means. Wealth lies in spending less than you earn. The rule: wealth is built not on how much you earn, but on how much of what you earn you keep. The gap between your income and your expenses is your true financial engine. Widen that gap deliberately and consistently, and regardless of your current income level, you will arrive at genuine financial freedom. Why it works. Most people increase their spending in direct proportion to their income. They get a pay rise, they buy a more expensive car, they receive a quarterly bonus, they move to a larger apartment, they build a successful business, they start flying business class and staying in 5-star hotels. This is lifestyle inflation, and it is one of the most insidious reasons why high earners end up with nothing saved year after year. They earn a great deal and spend every last bit. No real wealth is created, only a costly and demanding lifestyle that constantly requires more income just to sustain itself. People who genuinely build wealth think differently. They deliberately maintain the gap between what they earn and what they spend, regardless of income level, and consistently channel that gap into investments that generate passive income. Over time, passive income grows, while dependence on active daily labor decreases. That is what financial independence actually looks like, not simply earning more, but managing the difference between income and expenditure with discipline. Living below your means does not mean living in deprivation. It means choosing future freedom over immediate status, understanding the difference between what you genuinely need, what brings real satisfaction, and what you buy only because of advertising, social pressure, or the desire to impress others. What to do and how to apply it. 1. Set a clear, non-negotiable savings rate, a minimum of 20% of every dollar you receive. Make it automatic. The moment money arrives, transfer that share to your investment account before spending anything else. Live on the remaining 80%. You will be surprised how quickly you adapt. 2. Every time your income rises, resist the urge to immediately raise your spending. Direct at least half of any increase toward investments rather than consumption. This simple principle lets you improve your quality of life while accelerating wealth accumulation at the same time. 3. Conduct an honest audit of your monthly spending. Divide all expenditures into 3 categories: necessary, desirable, and status-driven. Keep the necessary. Scrutinize the desirable. Cut the status-driven without regret. Status purchases, things bought to impress others, consume the largest share of most budgets while delivering no lasting satisfaction. 4. Before any significant purchase, ask yourself 3 questions. Do I actually need this? Will it improve my life a year from now? And what investment opportunity am I giving up by spending this money? This brief pause dramatically reduces impulsive purchases you will later regret. 5. Avoid consumer credit as a way of financing your lifestyle. A loan for a car, a phone, or a vacation is simply paying for immediate gratification at your future self's expense. Interest payments are money flowing to the bank instead of working for you. 6. Create a clear, specific picture of the financial goal your discipline is building. A concrete sum, a concrete date, a concrete freedom. When that picture is vivid and real, choosing not to spend unnecessarily stops feeling like sacrifice and starts feeling like progress. Common mistake. People genuinely believe they will start saving once their income reaches a certain level. This is one of the most widespread and destructive financial illusions. If you cannot save from a modest income, you will not save from a large one, because spending habits scale with income automatically. Start now with whatever you have. The habit of saving is a muscle, and it only strengthens through consistent use. Result: wealth lives not in the size of your income, but in the space between what you earn and what you spend. Widen that space every month, and financial freedom becomes a matter of when, not if. Rule 12. Pay yourself first. Save before you spend, not after. The rule. Most people follow the same sequence. Pay all the bills, cover the necessary and not so necessary expenses, spend on entertainment, and whatever happens to be left at the end of the month, almost by accident, gets set aside. The problem is that almost nothing is ever left. Reverse the order. The moment any income arrives, as your very first action, transfer a preset amount to your investment account. Then live on what remains. This simple shift changes everything. Why it works. Human psychology is wired to spend whatever feels available. If $1,000 is sitting in the account, we find a way to spend $1,000. If 500 is there, we manage perfectly well on 500. This is not a character flaw. It is simply how the brain works, adapting to whatever it perceives as the available resource at any given moment. The pay yourself first principle uses this tendency in your favor. You remove the money before the brain registers it as spendable. You live on what remains, and you adapt without feeling deprived. The difference between save what's left and spend what's left after saving looks like a trivial matter of sequence. In practice, it is the difference between zero savings and steadily growing capital. The first approach depends on chance and willpower. The second depends on a system and automation. And a well-built system always outlasts even the strongest willpower, especially where money is concerned. This is why paying yourself first sits at the foundation of most wealthy people's financial lives. They do not wait for inspiration or the right moment. They do not hope something will be left at month's end. They have built an automatic system that works regardless of mood, workload, or current financial circumstances, as reliably as a utility bill going out every month. What to do and how to apply it. 1. Set up an automatic transfer from your main account to your investment account on the day you receive your salary. Not next week, not once things settle down. Today. Automation removes the need for a separate act of willpower each time and eliminates the risk of accidentally spending that money on something else. 2. Start with an amount that feels comfortable, even 5 or 10% of your income. The priority is to build a working system and the right habit. After a few months, once you see that you are living perfectly well on the remainder, gradually increase the percentage. A confident start matters more than the perfect opening amount. 3. Keep your investment or savings account separate, with no quick or easy daily access. Limited Axi SS is not an inconvenience. It is a deliberate protective barrier. The easier it is to retrieve the money, the more tempting it becomes to dip into it for current expenses. 4. Treat the payment to yourself as a non-negotiable bill, every bit as obligatory as rent or utilities. It occurs to no one to skip rent when money is tight. Apply the same standard to your investment contribution, without exceptions. 5. Whenever additional income arrives, a bonus, a gift, a tax refund, a windfall, immediately direct at least half to your investment account before you have had a chance to think of something to spend it on. Extra income is one of the most powerful accelerators of wealth that most people simply let slip through their fingers. 6. Every quarter, increase your automatic contribution by a small amount, even 1 or 2% of income. This gradual increase is barely perceptible day to day, but the cumulative effect over time is substantial. Common mistake. People are convinced there is simply nothing to save and keep waiting for the day their income grows large enough to make saving feel possible. But real experience shows the habit of saving has nothing to do with the size of income. It depends entirely on the order of actions and the existence of a system. A person with a modest income who pays themselves first will accumulate more over time than a high earner who pays themselves last, or not at all. Result: Make yourself the first creditor in your own financial life. Automate that payment, and wealth will begin building itself quietly and consistently every single month. Rule 13. Avoid consumer debt. Debt kills wealth. The rule: there are two fundamentally different kinds of debt. Investment debt helps create assets and generates income greater than the cost of the loan. Consumer debt is taken on for immediate pleasure and begins destroying your financial future the moment you sign. A loan for a car, a phone, clothing, a vacation. These are not tools for improving your life. They are a voluntary tax on impatience, paid to the bank instead of to yourself. Why it works. Consumer debt works against you on multiple fronts at once. The first is direct financial loss. When you borrow at 20% per year to buy something that loses 30% of its value in that same period, you are down 50% from the start. Every month, interest flows to the bank, money that could be compounding in your own investments instead. The second is psychological pressure. A person carrying debt is working not for freedom, but for the repayment of obligations. This is a low-grade but constant stress that degrades decision-making, drains energy, and undermines strategic thinking. Debt makes you dependent on a steady paycheck by necessity. You cannot afford to take risks, switch careers, or build something of your own while obligations hang over you. The third is opportunity cost. Every dollar directed toward repaying consumer debt is a dollar not working for you. At a loan rate of 20%, you have to earn those 20% back before you can begin moving forward. This is not a neutral position. It is moving backward, with significant effort required just to return to the starting line. Wealth grows when money works for you. Consumer debt inverts that equation entirely. You end up working for the bank's money. None of this is an argument for asceticism. Avoiding consumer credit is about the order of priorities. Save first, buy second. This principle protects your money and gives you time to test whether you actually want the thing. Experience shows that many desires for which people take out loans fade entirely by the time they have saved the necessary amount. Impatience is a costly emotion, and consumer credit is its financial expression. What to do and how to apply it. 1. Write down every current consumer debt, the balance, the interest rate, and the monthly payment for each. Seeing the full picture is the essential first step. Many people avoid this moment because the real numbers are uncomfortable. But not knowing does not free you from debt. It simply removes your control over it. 2. Pay down consumer debts in order of highest interest rate first. Each debt eliminated frees up cash flow that can be redirected toward the next one. This is the mathematically optimal approach and gets you out of the debt trap as quickly as possible with the least total cost. 3. Introduce a mandatory waiting period before any major credit purchase, at least 30 days. During that time, assess whether you could save the amount yourself within a reasonable period. If yes, save and buy outright. If no, that is a clear signal the purchase is beyond your current means. 4. Never use a credit card for purchases you cannot repay in full within the same month. A credit card with a grace period is a convenience tool, not a source of additional money. The moment you start paying interest on a credit card balance, you are paying some of the highest rates available anywhere in the financial market. 5. Build a personal emergency reserve covering 3 to 6 months of expenses. Most consumer loans are taken out precisely in crisis moments. A car breaks down, a medical bill arrives, an urgent cost surfaces unexpectedly. An emergency fund eliminates that trigger entirely and provides genuine financial confidence when the unexpected happens. 6. Shift your relationship with credit at the level of core belief. Stop treating it as a normal way of financing your life. Treat it as a last resort, reserved for genuine emergencies. This change in mindset reshapes your financial decisions automatically. Common mistake: People treat the monthly payment as the true price of a purchase. They think, I can afford $500 a month and take out the loan. But the real price is the total amount paid over the full term, including all interest. That figure is often 30 to 50% higher than the original sticker price. Calculate the actual cost, and your decision about whether to borrow will change immediately. Result: every dollar of consumer debt is a dollar working against your wealth. Eliminate that debt, and those same dollars will start working for you instead of for the bank. Rule 14. Reputation is worth more than money. Guard your good name. The rule: money can be lost and in time earned again. A reputation once destroyed is far harder to rebuild, and sometimes impossible. A good name in business and in life is an asset accumulated over decades of consistent, honest conduct. And it can be undone by a single poor decision, a single dishonest act, or a single moment of weakness. Guard it accordingly, because it is, in the end, the most valuable thing you have. Why it works. Reputation is not an abstract virtue or a matter of morality disconnected from practical life. It is a concrete economic asset that directly determines your financial opportunities. People with an impeccable reputation gain access to the best partnerships, the most attractive deals, the best lending terms, and the most promising investment opportunities. They are trusted without extensive due diligence or additional guarantees. Others seek them out. Clients, talented employees, and serious investors follow them willingly. Reputation lowers the transaction costs of every interaction. When you are known as someone who keeps their word, you do not need elaborate contracts and layers of legal protection to close an important deal. Look at the world's most enduring businesses. At their foundation, there is always deep consumer trust, built over years and decades through the consistent delivery on promises made. That trust cannot be purchased. It can only be earned through time and concrete action. And it is precisely this trust that constitutes the most durable competitive advantage a business can have, one that protects it more reliably than any patent or exclusive contract. The loss of reputation, by contrast, quickly destroys what took years to build. One public scandal, one deceived client, one instance of placing short-term gain above honesty, and years of careful work can unravel within days. In the age of social media and instant information, reputational risk is sharper than ever. A damaging story travels at extraordinary speed and lives online indefinitely. Protecting your reputation is no longer merely a question of ethics. It is a question of survival in modern business. What to do and how to apply it. 1. Honor every commitment, including the minor ones, even when it is inconvenient or costly in the moment. A reputation for reliability is built not through grand gestures, but through thousands of small, consistent actions. If you said you would call back, call back. If you committed to a deadline, meet it. It is precisely these small things that establish the image of someone trusted with genuinely important matters. 2. Never sacrifice honesty for short-term financial gain. Every time you face a choice between easy money and an honest course of action, remember, you are not simply making a financial decision. You are either investing in your reputation or withdrawing from it. The short-term gain from dishonesty almost never justifies the long-term cost of what follows. 3. Acknowledge mistakes openly and promptly. Do not wait until the situation has spiraled. People forgive errors far more readily than cover-ups. A swift, honest acknowledgement of a problem often builds more trust than if nothing had gone wrong in the first place. Transparency and accountability attract genuine confidence. 4. Choose carefully with whom you do business and with whom you are publicly associated. Reputation travels in both directions. An association with people or organizations of questionable standing inevitably reflects on your own name, even if you have done nothing wrong personally. Your circle is always part of your public image. 5. Behave consistently, in public and behind closed doors. A genuine reputation is not a performance for an audience. It is how you behave when no one is watching. That is ultimately what becomes known to everyone, because people who have seen you in both settings will always exist. 6. Ask yourself regularly, what do partners, clients, and colleagues say about me when I am not in the room? The answer to that question is more telling than any financial report. It is the most accurate indicator of your future opportunities. Common mistake. People believe reputation is what they say about themselves, their stated values, principles, and mission. But reputation is solely what others say about you, based on your actual behavior. Words unconfirmed by action do not build reputation, they undermine it. The most damaging reputation of all belongs to someone whose words consistently fail to match their deeds. That is the hardest reputation to escape. Result: build your reputation as methodically and consistently as you build your capital. It is a long-term investment with the highest and most reliable return available to you. Rule 15. Do what you love. Money follows passion. The rule: the most sustainable path to financial success is to find a pursuit you love so much that you are willing to devote yourself to it even without immediate reward. Genuine passion provides an energy that cannot be faked and cannot be bought. It is what turns an ordinary person into a world-class expert. Because a beloved pursuit gets studied more deeply, practiced more persistently, and refined over far longer than any work undertaken purely for money. Why it works. People who work solely for money have a fundamentally different relationship with their work than those who are genuinely passionate about it. The first group stops when things get hard. The second keeps going precisely when everyone else has quit. The first does just enough to get by. The second consistently delivers more than is expected. The first watches the clock. The second loses track of time entirely. This difference in approach compounds over the years and creates an enormous gap in mastery, professional reputation, and, as a natural consequence, financial results. Passion is also the most powerful source of personal resilience. On the way to any meaningful success, periods of difficulty, disappointment, and genuine doubt are unavoidable. It is at those pivotal moments that it is decided who continues and who walks away. A person working purely for money tends to look for an easier path the moment things get seriously difficult. A person who loves their work pushes through, because the work itself matters more than the temporary obstacles in the way. This is not romanticism. It is a real practical competitive advantage that operates every single day. The connection between passion and money, however, is not automatic or instant. It requires time, deep mastery, and a deliberate strategy. Passion without competence does not produce sustainable income. But passion combined with genuine expertise, a real ability to create value for others, and a commitment to continuous development, that combination eventually leads to financial success. Money follows mastery. Mastery follows passion. That is the complete equation. What to do and how to apply it. 1. Ask yourself honestly, what would you do if money were not the deciding factor? What tasks do you approach with energy and enthusiasm rather than a sense of duty? What subjects do you explore in your free time with no external pressure to do so? The answers will point you toward where your passion already lives, perhaps closer than you have realized. 2. Begin developing your passion as a professional competence. Passion on its own does not pay the bills. Mastery does. Find ways to transform what you love into a deep expertise that creates real, tangible value for other people and that they are willing to pay well for. This takes time, but it builds the most durable career and financial foundation available. 3. Do not abandon your current work all at once in pursuit of your passion. Build it in parallel, in the evenings, at weekends, gradually developing both competence and income. When earnings from your passion reach a stable level, the transition will not be a leap into the unknown, but a logical, confident next step. 4. Look for the intersection of three things: what you love, what you can genuinely become excellent at, and what people are realistically willing to pay for. Only at the junction of all three does work exist that brings both deep satisfaction and real financial reward. Passion without value for others remains a hobby, not a profession. 5. Spend time with people who have successfully built a livelihood from their passion. Their experience, energy, and living proof that it is possible are among the most powerful sources of both inspiration and practical guidance. In that company, your own resolve strengthens and doubt loses its grip. 6. Measure progress not only in money, but in depth of mastery, quality of expertise, and the value you are creating. In the early stages, these indicators grow faster than income, and they are the most reliable predictors of where your finances are headed. Common mistake: people wait for financial security to arrive first and plan to pursue what they love only once it has. This is inverted logic. Money comes as the result of mastery and value, not as a precondition for developing them. The person waiting for security before starting risks waiting forever. Start now, even at the smallest scale. Movement creates opportunities that standing still never will. Result: find the work that genuinely energizes you, build mastery in it, and create real value for others. And money will follow as the natural outcome of that path, not as its sole purpose. Part 4. Continuous learning. Rule 16. Read every day. Knowledge compounds like interest. The rule: knowledge operates on the same principle as compound interest. Every book read, every idea studied, every new concept absorbed does not exist in isolation. It connects with what you already know, deepens it, opens new connections, and creates a level of understanding unavailable to those who do not read. The more you know, the faster you absorb what is new. The more you absorb, the more valuable you become as a professional, an investor, and a person. This is a self-reinforcing process of building intellectual capital that no one can ever take from you. Why it works. Most people stop actively learning the moment they finish formal education, convinced that what they know is sufficient for a successful career and life. But the world is changing faster than at any previous point in history. Entire industries transform within a few years. Technologies become obsolete. Business models that worked perfectly yesterday become irrelevant today. In such a world, a person who has stopped learning is not simply standing still. They are slowly falling behind everyone who keeps growing. Reading is the most accessible, most concentrated, and most effective way to absorb other people's experience and hard-won knowledge. A single good book contains decades of the author's reflection, research, and practical experience. In a few hours, you gain direct access to conclusions that took another person a lifetime to reach. By almost any measure, that is one of the best transactions available to anyone, at any level of financial means. A person who reads consistently holds a durable advantage in decision-making. They see patterns where others see only chaos. They know how similar situations have unfolded before. They understand the mechanisms behind events. They are far less susceptible to panic and euphoria, because history and biography have shown them that extreme conditions, in markets and in life, are always temporary. All of this translates directly into better decisions, and better decisions translate into better financial outcomes and a richer life. What to do and how to apply it. 1. Set a daily reading minimum, at least 30 minutes, without exception. 30 minutes a day is roughly 20 books a year. 20 books a year is 200 books over a decade. A person who has read 200 books in their field and adjacent disciplines possesses a depth of understanding most competitors simply cannot match. That is compound interest in knowledge, in its purest form. 2. Read with purpose, not at random. Identify the areas whose mastery directly serves your goals. Investing, decision-making psychology, business, history, the lives of exceptional people. Build a reading list for the year and work through it methodically. Random reading produces random results. Purposeful reading builds a deep, interconnected body of knowledge. 3. Read not only for information, but for the transformation of your thinking. The best books do not just deliver new facts, they offer new ways of seeing the world. After each chapter, ask yourself, what exactly will change in my thinking or behavior as a result of this idea? Reading without application is entertainment. Reading with application is a long-term investment in yourself. 4. Take notes and build a personal knowledge system. Write down key ideas and the thoughts that arise during reading. Review those notes regularly. Knowledge that is never recorded quickly disappears. Knowledge that is recorded and revisited stays with you and continues to work for years. 5. Read biographies of people you admire and want to emulate. Biography is the most direct route into the genuine thinking of outstanding people. By reading how they thought, what difficulties they faced, and how they made pivotal decisions, you absorb their approaches and begin adapting them to your own life. 6. Use spare time for reading or audiobooks. The commute, a queue, a lunch break. These small fragments collectively add up to hours of daily learning. People who use this time deliberately accumulate knowledge continuously with almost no extra effort required. Common mistake. People begin reading with great enthusiasm, work through a few books, and then stop when the initial motivation fades. The problem is that they treat reading as a project with a beginning and an end, rather than a way of life. The real value of daily reading does not reveal itself after a month or a year. It reveals itself after 5, 10, 20 years of continuous accumulation. That is the horizon to keep in mind on a difficult evening when opening a book is the last thing you feel like doing. Result: every page you read today becomes part of the intellectual capital that works for you for the rest of your life. Read every day, and in years to come, you will barely recognize who you were when you started. Rule 17. Invest in yourself, the asset with the best returns. The rule: any investment can lose value. Stocks fall, property depreciates, businesses fail. But there is one asset that never depreciates and can never be taken from you under any circumstances: your knowledge, skills, and competencies. Investment in yourself delivers the highest, most reliable, and most enduring return of any investment available. Every dollar directed toward your own development has the potential to come back tenfold, even 100-fold, over the course of your life. Why it works. When you invest in stocks or property, you receive income from the labor and capabilities of others. When you invest in yourself, you increase your own capacity to create value, and therefore to earn more, make better decisions, and access opportunities that were previously beyond your reach. That is a fundamental difference. Financial assets work for you in limited and variable ways. You yourself, equipped with knowledge and skills, work for you with a return that grows over time. Consider a straightforward example. A person who spends a modest amount on a negotiation course and improves their deal-making by just 10% will recover that investment many times over in the first year alone. A person who learns a second language gains access to markets, projects, and opportunities that simply did not exist in their previous world. A person who masters a new skill in their field becomes more valuable to employers, partners, and clients, and their market worth rises accordingly. Every investment in yourself creates an effect that continues to pay out for years and decades. Investment in yourself is not limited to formal education and expensive courses. It includes books, mentors, professional conferences, internships, new experiences, and the health of both body and mind. Everything that expands your capabilities, raises your competence, and improves the quality of your decisions. Even investments in physical health and psychological well-being affect financial results directly, because a healthy, energetic, clear-thinking person works more productively, makes sounder decisions, and sustains higher demands without losing effectiveness. What to do and how to apply it. 1. Allocate a fixed percentage of your income specifically for self-development, at least 5 to 10% each month. Treat this with the same seriousness as any other mandatory payment. This is not an expense. It is an investment with the highest guaranteed return in your portfolio. 2. Regularly assess your current skills and identify honestly the gaps that are limiting your growth. Which single skill, if developed, would give you the greatest increase in market value right now? Focus your investment there, rather than spreading it thinly across everything that happens to look interesting. 3. Find a mentor, someone who has already achieved what you are working toward. This might be paid coaching, a formal mentorship program, or simply regular conversations with an experienced person you respect. A good mentor cuts years off your path to your goals by helping you avoid mistakes that cost others dearly. In terms of time to result, it is one of the most effective investments you can make. 4. Invest in your health as a primary asset. Good nutrition, consistent sleep, physical activity, and stress management are not comfort expenditures. They are direct investments in your productivity and longevity. Economizing on health today reliably results in far greater costs tomorrow, in money, time, and missed opportunities. 5. Build an environment that drives growth. Professional communities, conferences, and peer groups populated by people at your level and above. These are settings in which development accelerates naturally. Environment sets the standard. High standards produce high results. 6. Never defer investment in yourself on the grounds of insufficient time or money. That is a trap. The moment resources feel scarce is precisely when investing in the skills that will create them matters most. The real scarcity in your life is not money, it is competence. Address that shortage, and the money will follow. Common mistake. People treat spending on their own development as a luxury they can afford only after financial success has been achieved. This is exactly backward. Investment in yourself is what creates financial success, not the reward for it. A person who defers development until better times never actually moves closer to those better times, waiting for fruit without ever planting the tree. Result: no market crash can erase your knowledge, and no inflation can devalue your skills. Invest in yourself consistently and generously, and this asset will work for you for life, growing more valuable with every passing year. Rule 18. Learn from others' mistakes. Your own won't cover all the lessons. The rule: life is too short and the cost of serious mistakes too high to learn exclusively from personal experience. Whoever studies the failures of others gains invaluable lessons without paying for them with their own time, money, and health. Wisdom is not simply lived experience. It is the ability to absorb lessons from other people's experience as deeply and genuinely as if you had lived through them yourself. Why it works. Every major financial catastrophe, every significant bankruptcy, every notable business failure has already happened and been documented in detail. Stories of how people lost entire fortunes, destroyed promising companies, and made catastrophic decisions are available to anyone. In books, biographies, analytical articles, and thorough post-mortems. This is an enormous library of lessons already paid for by others, with their money, their reputations, and years of their lives. To ignore it in favor of personal experiment is not courage or originality, it is waste. Look at the recurring patterns of financial disaster. They are strikingly consistent across eras: excessive debt, investment in poorly understood assets driven by fear of missing out, blind trust in charismatic fraudsters, deliberate disregard of warning signs to preserve a comfortable illusion of control. These mistakes were made by millions of people before you, and will be made by millions more who do not take the trouble to study history carefully. A person who knows these patterns is far better protected against repeating them than one who relies solely on intuition in the heat of the moment. Studying others' mistakes is valuable not only as protection against failure, it is also a practical accelerator of success. Knowing which paths reliably lead to dead ends, you find the ones that lead to your goals far more quickly. Knowing which approaches in business and investing consistently fail, you narrow your field of search and concentrate your efforts where the probability of success is meaningfully higher. This saves not just money, but the most irreplaceable resource of all: time. What to do and how to apply it. 1. Make the study of others' failures as regular a part of your education as the study of success. When you read about a bankruptcy or an investment catastrophe, ask yourself one specific question. What exactly was the decision or belief that led to this outcome? Write down the answer. Over time, you will build a personal knowledge base of what must never be done, and that is no less valuable than knowing what must. 2. Study the history of financial crises and market bubbles. The tulip mania of the 17th century, the dot-com crash of 2000, the mortgage crisis of 2008. Each is a comprehensive case study in crowd psychology, greed, and the illusion of perpetual growth. Understanding these episodes makes you far more resistant to the next bubble, which will inevitably arrive wearing a different name. 3. Read biographies not only of successful people, but of those who suffered serious failures. The stories of failed entrepreneurs and investors are often more instructive than stories of triumph. They show clearly the specific point where a wrong decision was made and precisely why. Success is frequently shaped by circumstance. Failure almost always has a clear and repeatable internal logic. 4. When someone in your circle makes a significant business or financial mistake, do not simply observe, analyze it. What exactly went wrong? What belief or what moment of looking the other way led to this outcome? Real examples from people you know personally are among the most deeply absorbed lessons, because you understand the full context from the inside. 5. Keep a personal journal of error analysis, covering both others' mistakes and your own. When you record a lesson in writing and return to it regularly, it becomes part of how you think, not just an interesting story you will soon forget. 6. Before any major financial or business decision, ask yourself, who has already attempted something similar? And what happened? The answer is often available in public sources and can protect you from a costly mistake faster than almost any other form of analysis. Common mistake. People are convinced that others' experience does not apply to them. My situation is unique. I'm smarter. This time is different. These thoughts are the classic prelude to repeating others' mistakes word for word. Human nature does not change. The mechanisms of greed, fear, and self-deception operate the same way in every era. The people most certain they are exceptions to the general rules most often become the newest entries in the old catalogue of avoidable failures. Result: history has already paid in full for every major lesson about money, business, and life. Your task is to read those lessons carefully, before paying for them again yourself. Rule 19. Surround yourself with the best. You become the average of your 5 closest people. The rule: you cannot rise above the level of your environment, just as water cannot rise above its source. The people with whom you spend the most time imperceptibly but inevitably shape your standards, beliefs, habits, and financial outcomes. Choose your environment consciously This is one of the most powerful and most consistently underestimated decisions you will ever make. Why it works. The influence of environment on a person runs far deeper than most of us are willing to acknowledge. We absorb the habits of those around us, through conversation, through daily observation of how they live, through what they consider normal, possible, and worth striving for. If the people around you genuinely believe that wealth is the privilege of a lucky few, that investing is too complicated and risky, and that serious ambition is arrogance, you gradually begin to share those beliefs. They seep into your thinking through routine exchanges, habitual jokes, and the way people respond to your ideas and goals. The reverse works just as powerfully. When you surround yourself with people who think ambitiously, who invest, build businesses, develop consistently, and achieve meaningful results, their standards quietly become your standards. What once seemed out of reach begins to feel like the norm. What once intimidated you no longer does, because you see real people who have already walked that road. Ambition is contagious. Discipline is contagious. And results are contagious too. Beyond mindset, the right environment provides direct access to opportunities that are simply closed to those in a lower quality setting. The best deals, the best partnerships, the most promising investment ideas, all of these move through personal connections and relationships of trust. A person known and respected in a circle of high achievers gains access to information and opportunities that exist nowhere in the public domain. Your network is an invisible but genuinely valuable asset. What to do and how to apply it. 1. Conduct an honest audit of your current environment. Write down the 5 people with whom you spend the most time. Look at their financial situation, their attitude toward money, their ambitions, and their actual results. If the average of those 5 people is not the level you are working toward, that is a clear signal for conscious change, not to dismiss these people, but to deliberately expand your circle. 2. Seek out people who have already achieved what you are working toward. Professional conferences, industry associations, investment communities, and educational programs are places where high-standard people concentrate. A single meaningful connection at such an event can fundamentally alter the trajectory of your life. 3. Become someone that successful people want in their world. This point is important and often overlooked. It is not enough to want proximity to the best. You must have something genuine to offer: knowledge, value, honesty, reliability. Work on yourself so that your presence enriches others rather than simply drawing on their time and resources. 4. Deliberately limit time with people whose thinking consistently pulls you down. This does not mean severing relationships abruptly. It means managing the dose of their influence on your thinking. You are not obliged to let other people's limiting beliefs define your own sense of what is possible. 5. Use books and biographies to expand your environment when direct access to exceptional people is limited. Reading regularly about great investors and entrepreneurs quietly but steadily raises your internal standards, putting you in company with the finest minds in history on your own schedule. 6. Mentor those who are earlier in their development than you. Teaching something to another person is one of the most effective ways to deepen your own understanding. The best people in any field are always surrounded by both those from whom they learn and those they teach. That complete exchange of knowledge and energy is what keeps growth alive. Common mistake. People wait until they have achieved success before seeking out the right environment, as though that environment is a reward rather than a cause. The logic, in fact, works the other way. The right environment creates the conditions for success. Entering a circle slightly above your current level is uncomfortable at first. That discomfort is the signal that you are moving in the right direction. The discomfort of growth is always preferable to the comfort of stagnation. Result: choose carefully the people with whom you spend your time. This is not merely a choice about pleasant company. It is a choice about who you will become in 5 years. Your environment is your future, made visible in the people around you. Rule 20. Acknowledge mistakes. Honestly, it's a strength, not a weakness. The rule, the ability to acknowledge one's own mistakes openly and promptly, is one of the rarest and most valuable skills in business, investing, and life. People who can say, "I was wrong," without hesitation, and change course immediately lose less, grow faster, and earn far more trust than those who defend their errors to the end at any cost. Acknowledging a mistake is not a weakness of character or a loss of standing. It is the clearest expression of intellectual honesty, maturity, and genuine self-confidence. Why it works. The human brain experiences acknowledging a personal error as a direct threat to self-esteem and social standing. This is why people instinctively and forcefully defend their decisions, seeking justifications, looking elsewhere for blame, rather than simply admitting the original decision was wrong. This is confirmation bias, and it is one of the primary reasons investors hold losing positions too long. Entrepreneurs keep pouring resources into failing projects, and executives stubbornly defend strategies that stopped working long ago. The financial consequences of this pattern are substantial and grow with every day of delay. The losing investment continues to decline. The wrong hire continues to damage the team. The flawed strategy continues to consume resources and time. The cost of delay almost always exceeds the cost of the original mistake. Prompt, honest acknowledgement stops the damage immediately. Denial and self-deception turn a manageable wound into a serious threat to everything you are building. Paradoxically, people who acknowledge their mistakes openly tend to command more trust and respect, not less. Admitting an error signals intellectual honesty, genuine confidence, and emotional maturity. It tells the people around you, this person can be trusted with what matters because they will not conceal problems to protect their image. These are precisely the people to whom money, reputations, and serious decisions get entrusted. What to do and how to apply it. 1. Develop the habit of regularly reviewing key decisions and asking yourself honestly, if I were making this decision today, knowing everything I know now, would I make it again? If the honest answer is no, that is the signal to acknowledge the mistake and change course, not to find fresh justifications for staying put. 2. Separate the mistake from your identity. Acknowledging that a specific decision was wrong is not the same as declaring yourself incompetent or a failure. Everyone makes mistakes, the experienced and the novice, the sharp and the slow. The only meaningful difference is how quickly a person acknowledges it and what they do next. 3. Build a culture of psychological safety within your team or immediate circle, one where acknowledging mistakes is encouraged rather than punished. Organizations where people fear admitting errors consistently hide problems until they become crises. Organizations where mistakes are acknowledged quickly and openly fix them early and learn faster than their competitors. 4. Keep a personal journal of mistakes and lessons. Record each wrong decision, its causes, and what you would do differently. Over time, this journal becomes your most honest and most practical guide, written entirely from your own experience, without embellishment. 5. When a mistake has affected others, clients, partners, colleagues, acknowledge it to them promptly, specifically, and without excessive justification. Say what went wrong, what you are doing to correct it, and what will change. This approach does not damage relationships. It strengthens them, often more durably than if the mistake had never happened. 6. Conduct a structured review after every significant decision or project, regardless of outcome. What worked? What did not? Which assumptions proved false? This practice transforms every mistake into a lasting learning asset. Common mistake. People confuse acknowledging a mistake with public humiliation and the loss of authority. They believe that saying, "I was wrong," instantly destroys others' confidence in them. The reality is the opposite. People who never acknowledge mistakes are perceived as rigid, unreliable, and defensive. People who acknowledge mistakes honestly and in a timely way are perceived as strong, mature, and trustworthy. The fear of admitting a mistake invariably costs far more than the mistake itself. Result: mistakes are inevitable for anyone who acts and takes risks. Your strength lies not in their absence, but in how quickly and honestly you face them. Acknowledge fast, correct immediately, and keep the lesson forever. Part 5. What to do in practice. Rule 21. Start investing early, even with small amounts. The rule: the most costly investment decision most people ever make is the decision to wait until they have accumulated enough, to wait until they know more, to wait for the right moment. Every year of waiting costs you not just lost returns, it costs years of compounding that cannot be recovered at any price. Start today with whatever you have right now, and time will become your most powerful ally. Why it works. The mathematics of an early start is striking, even for those who already understand compound interest. Consider two people. The first began investing a fixed amount each month at 25 and continued for 40 years. The second started at 35 with the identical amount and the same annual return. The gap in their final wealth, produced by that single 10-year difference, runs into the millions. The first person was not smarter, did not work harder, and did not invest more. They simply started earlier and let time do its work. This is why time is the most important factor in investing, more important than the size of the initial capital, more important than the choice of instruments, and more important than market conditions at the moment of entry. A modest amount invested today will, in 30 years, become something genuinely significant. A larger amount invested 10 years later due to delay will never catch up, because those 10 years of compounding are gone forever. Rid yourself of the idea that investing only makes sense with substantial sums. This belief is one of the most common barriers to ever getting started. Consistency and discipline matter more than contribution size. A person who invests a small but steady amount every month for 20 years will build more capital than someone who waited years for a large lump sum and began a decade later. Contribution size can grow as income grows. Lost time cannot be recovered. What to do and how to apply it. 1. Start investing today with what you have right now. It may be a small amount. That does not matter. What matters is launching the process and building the habit. The first contribution is the most important step because it sets the mechanism in motion, one that will work for you for the rest of your life. 2. Set up an automatic monthly contribution to your investment account, even a modest one to begin. Automation solves the discipline problem once and for all. You do not need to make a fresh decision each month. The system runs regardless of your mood, workload, or financial circumstances at any given moment. 3. Do not wait for perfect knowledge, ideal conditions, or the perfect entry point. A basic understanding of index funds, diversification, and long-term investing is entirely sufficient to begin with confidence. Investing is a skill that improves through real practice. No amount of theoretical preparation substitutes for even 1 year of actual investing with your own money. 4. Increase your monthly contribution whenever your income rises. A pay rise is an opportunity to meaningfully accelerate wealth accumulation, not a reason to raise your spending immediately. Even small regular increases to the contribution amount produce a dramatic cumulative effect over a long investment horizon. 5. Calculate the specific difference, in real numbers, using your own figures, between starting today and starting 3 years from now. Use an online compound interest calculator. This concrete picture will do more to motivate you than any abstract argument. When you see actual dollar amounts, delay instantly loses its appeal. 6. Start with simple, accessible instruments, index funds, or broadly diversified portfolios. There is no need to master complex strategies from the outset. Simplicity and consistency at the start are worth more than sophistication. Complexity can be layered in gradually as your experience and market understanding develop. Common mistake. People tell themselves they will start once they understand things better, have saved more, or found the right moment. Months pass, then years. The moment never arrives, and the most valuable resource, time, flows away irreversibly. An imperfect but real start today is always better than a perfect start in an uncertain future. The market does not wait for you to feel ready. Result: the best time to start investing was yesterday. The second best time is right now. Every day of delay is real money you are voluntarily giving up forever. Rule 22. Hold a cash reserve for opportunities and crises. The rule: a cash reserve is not money sitting idle and losing value. It is an insurance policy, the foundation of financial peace of mind, and a loaded weapon for seizing the best opportunities when they arise. An investor without a cash reserve is a soldier without ammunition, capable of looking formidable but helpless at the decisive moment. Keep a supply of free funds at all times, and you will turn any crisis from a threat into an opportunity rather than the reverse. Why it works. A cash reserve serves two entirely different but equally essential functions in your financial life. The first is protective. When the unexpected happens, job loss, illness, urgent repairs, sudden major expenses, the reserve lets you handle the situation without being forced to sell investment assets at the worst possible time. Without a reserve, any life crisis immediately becomes a financial crisis. With one, you retain full control, where most people fall into panic and make decisions they later regret. The second function is offensive. Markets periodically crash, and those crashes create rare opportunities to buy quality assets at genuine bargain prices. Precisely in those moments, when everyone around you is selling in panic and the prices of excellent companies fall 30, 40, or 50%, cash on hand becomes the most powerful tool for rapid wealth accumulation available. Only those with free funds at that specific moment can act on those opportunities. Everyone else can only watch as once-in-a-decade chances pass them by. This distinction separates the experienced investor from the beginner. The beginner views cash as a loss, money not working, being eaten by inflation. The experienced investor views cash as a valuable option, the right to buy an excellent asset at an excellent price when that chance inevitably comes. That right carries real and substantial value, more than compensating for the modest returns forgone during calm periods. What to do and how to apply it. 1. Build and maintain a personal emergency reserve covering 3 to 6 months of living expenses. This is your financial safety cushion, kept strictly separate from your investment portfolio, never deployed into risky assets. Its sole purpose is to be permanently available, liquid, and sufficient to cover any of life's surprises without stress or forced decisions. 2. In addition to the personal cushion, maintain a separate investment cash reserve of 10 to 20% of your portfolio value. This money is intended exclusively for market corrections and crashes. It waits patiently, and when its moment arrives, it becomes the best investment opportunity of many years. 3. Decide in advance the specific conditions under which you will deploy the investment reserve. For example, a market decline of 20%, or a specific company falling to 30% below your target entry price. Criteria, set in advance, allow you to act quickly and rationally precisely when emotions are pushing you in the opposite direction. 4. Keep the emergency fund in highly liquid, reliable instruments, savings accounts, short-term bonds, money market funds. It must be accessible within 1 to 2 days without loss of value. Do not chase maximum returns on reserve funds. Their job is not to earn. It is to be ready. 5. Resist the temptation to invest every available dollar in pursuit of maximum current returns. When markets are rising, holding cash can feel like waste. When markets fall, cash becomes the most valuable asset in your entire portfolio. 6. After deploying any part of the reserve, replenish it to the target level before building up investment positions again. A reserve that has been spent and not restored cannot fulfill either its protective or offensive function when the next critical moment arrives. Common mistake. People liquidate their reserve in good times, telling themselves that money must work and must not sit idle. Then, when a crisis hits or a rare opportunity appears, they have neither protection nor firepower. They are forced to sell assets at a loss or watch excellent opportunities go to those who are prepared. The absence of a reserve at the critical moment costs far more than any return forgone during a period of calm growth. Result: a cash reserve is not caution or indecision. It is a strategic instrument that simultaneously protects everything you have built and gives you the power to act decisively when others are forced to retreat. Rule 23. Diversify if you're not an expert. Don't put all your eggs in one basket. The rule: unless you are a genuine deep expert in a specific sector or company, with years of analytical experience and firm, well-tested conviction in your conclusions, never concentrate all your capital in a single asset or a single idea. Diversification is not timidity, and it is not a sign of weak conviction. It is a rational and necessary response to a fundamental truth. No one can predict the future with certainty, and even the most careful analysis is sometimes wrong for reasons that could not have been foreseen under any circumstances. Why it works. The history of financial markets is filled with stories of people who were completely convinced of the soundness of their investment decisions and lost everything. Talented analysts, experienced entrepreneurs, wealthy investors staked their entire capital on one asset, one company, one sector, and ran into circumstances that had not featured in any of their carefully constructed scenarios. A competitor's technological breakthrough, an unexpected regulatory decision, fraud inside company management, an unforeseeable geopolitical shift. Any one of these factors can completely destroy even the most apparently robust investment thesis. Diversification solves this problem cleanly without requiring perfect foresight. When capital is sensibly distributed across different assets, sectors, and geographic markets, the catastrophic failure of one position is no longer catastrophic for the portfolio as a whole. It becomes an unpleasant but manageable event. The portfolio continues to function. Other positions partially offset the loss or continue growing independently. You preserve your capital and the ability to move forward, rather than starting over from zero after a single setback. The key distinction is between genuine diversification and simply scattering money across many things. Genuine diversification means the conscious distribution of capital across assets that behave differently under different market conditions. Stocks from different sectors, bonds, property, different geographic markets. When some fall, others hold firm or continue to grow. It is precisely this lack of correlation that creates real protection, not simply a larger number of holdings. What to do and how to apply it. 1. Never invest more than 10 to 15% of your investment capital in a single company or asset, even one whose prospects seem exceptional. An exception applies only to true deep experts with years of relevant experience and a thorough understanding of all the risks involved. In all other cases, excessive concentration is an unjustified gamble, not an expression of confidence. 2. Distribute capital across different asset classes: stocks, bonds, property, cash instruments. Each class responds differently to economic cycles, inflation, and interest rate changes. The right combination reduces overall portfolio volatility without meaningfully reducing long-term returns. 3. Diversify within each asset class across sectors and geographies. In equities, do not hold everything in technology or in a single country. Economic conditions and growth rates vary significantly across sectors and markets. What is working well in one sector today can become a serious source of problems tomorrow. 4. Consider index funds as the foundation of your portfolio. A broad index fund automatically provides diversification across hundreds or thousands of companies within a single simple instrument, accessible, low cost, and proven for investors who are not claiming to pick individual winners. 5. Periodically review and rebalance your portfolio. Over time, some positions grow and come to occupy too large a share. Others decline. Regular rebalancing returns the portfolio to its target allocation and naturally enforces the principle of buying low and selling high without any need to forecast the market. 6. Diversify not only your financial assets, but also your sources of income. Dependence on a single employer or a single client is the same dangerous concentration of risk as putting all capital into a single stock. Multiple income streams create a financial stability that no portfolio, however well diversified, can provide on its own. Common mistake: people diversify incorrectly, buying many different assets that in reality move in the same direction. Holding 10 different technology stocks, for example, feels like diversification, but provides almost none of it. In a sector-wide downturn, all 10 positions fall together. Genuine diversification requires low correlation between assets, not simply a large number of them. More holdings within one sector is the illusion of protection, not the real thing. Result: diversification is the only free lunch in investing. It reduces risk without requiring a proportional reduction in returns. Use it consistently, and no single mistake in the portfolio will ever become a catastrophe. Rule 24. Avoid hype and trendy themes. When everyone is buying, it's already too late. The rule: when an investment idea becomes so popular that everyone is talking about it, in the news, on social media, at the dinner table, it has almost always already ceased to be a genuine opportunity and turned into a trap for latecomers. The best investment opportunities are not found where universal attention shines, but where it is still dark, in undervalued, overlooked, and poorly understood assets. Mass hype is almost always a sign of inflated prices, not of an outstanding opportunity. Why it works. Financial markets operate on a straightforward and unchanging principle. An asset's price reflects the aggregate expectations of all market participants at any given moment. When everyone is saying that something is bound to rise, those expectations are already priced in. The buyers have already arrived. The money has already been deployed. The price already reflects the most optimistic possible scenario, with no margin for error. Buying at that moment means paying for the excited hopes of a crowd, not for the real value of the underlying business. Recall the most famous financial bubbles in history: the tulip mania of the 17th century, the railway boom of the 19th, the dot-com frenzy of the late 90s, the cryptocurrency fever of the early 2020s. In each case, there was a real technology or a real idea behind it. But asset prices rose so far above that reality that investors who bought at the peak of the frenzy lost a substantial portion of what they put in. The idea may have been revolutionary, the growth may have been genuine, but the price was irrational, and it is the price always that determines the outcome for those who arrive last. The difficulty is that refusing to participate is psychologically brutal, even for experienced investors. Everyone around you appears to be making money. The fear of missing out reaches its peak precisely when actual risk is also at its highest. It is at exactly that moment that most people finally decide to enter, and that moment frequently turns out to be the top. What to do and how to apply it. 1. Establish a personal rule. If you hear about a particular investment asset or idea more than 3 times in a week from completely different sources, treat that as a signal for heightened caution, not a prompt to buy. Widespread awareness of an investment idea means that most potential buyers have already bought or are poised to do so. Further upside is limited. The risk of a sharp reversal has grown substantially. 2. Before investing in any popular theme, ask yourself one essential question. What am I actually paying relative to the real value of this business right now? If the stock is priced to assume flawless growth for 20 years under the most favorable conceivable conditions, you are paying for a fantasy. Any deviation from the perfect scenario will lead to a painful correction. 3. Deliberately look in the opposite direction, at assets everyone is avoiding, that are out of favor, that analysts dismiss as dull and uninteresting. That is where the best opportunities tend to hide. Unloved assets are cheap. Cheap assets with solid fundamentals are precisely what produces outstanding long-term results. 4. Keep a clear distinction in your thinking between the quality of an idea and the quality of an investment. An excellent company can be a terrible investment if you are buying it at an inflated price. A mediocre company can be a sound investment if you are buying it at a deep discount to real value. Price always matters, regardless of how compelling the story sounds at the time. 5. If you decide to invest in a popular theme anyway, do so with firm, pre-established limits. Set a maximum portfolio allocation for the position, define your exit conditions, and stick to them. Hype investments demand stricter discipline than most, precisely because emotional involvement runs higher. 6. Study the history of financial bubbles and the narratives that surrounded them. You will find a striking consistency. In every case, participants sincerely believed that this time is different. That conviction is the single most dangerous and most widespread belief at the peak of every market bubble across history. Common mistake. People confuse popularity with real value. If everyone is buying, the thinking goes, it must be a good idea. In reality, mass buying most often signals that a good idea has long since become an overvalued asset. The most informed money enters when no one is looking, and exits with confidence when everyone is declaring inevitable eternal growth. Following the crowd in investing means systematically buying high and selling low. Result: the best investment opportunities are rarely popular at the moment they appear. Develop the ability to think independently of the crowd, and the market will reward you for it repeatedly. Rule 25. Reinvest your profits. Don't spend investment income. The rule: every time you withdraw profit from your investment portfolio and spend it, you physically shut down one of the most powerful wealth creation mechanisms in existence. Compounding in real action. Reinvesting profit is not a sacrifice or a denial of well-earned reward. It is the deliberate decision to allow money to produce more money, building capital that will in time give you far more than any immediate pleasure from profits spent today. Why it works. Consider 2 scenarios. In the first, you invest $1 million at 10% per year and withdraw the $100,000 earned each year for personal expenses. After 30 years, your portfolio still holds $1 million, and you have spent $3 million over that time. In the second, you reinvest all profits without a single withdrawal. After 30 years, the portfolio exceeds $17 million. The difference is vast, almost hard to believe, and it is explained entirely by one decision: reinvest or spend. This is precisely why Berkshire Hathaway has never paid dividends. Every dollar earned was reinvested into businesses with high returns on capital. Applied consistently over decades, that single principle accounts in large measure for the company's extraordinary growth and the wealth it created for its shareholders. Reinvestment is not merely a financial tactic. It is a philosophy of long-term wealth creation, practiced without exception by every great investor in the history of finance. This does not mean you can never enjoy the fruits of your investments. It means consciously deferring significant consumption until the point where your capital has grown large enough that investment income fully covers your living expenses without touching the principal. That is financial independence in its truest sense, not the moment you begin spending capital, but the moment you live entirely from the natural growth of your assets. What to do and how to apply it. 1. Set up automatic reinvestment of all dividends and coupon payments in your brokerage account. Most modern brokers offer this as a single setting. Automation eliminates the temptation to redirect those funds elsewhere. They continue working without any decision required on your part. 2. Maintain a clear separation in both thinking and practice between two flows of money, income for living and profits for growth. Live on what your labor produces. Return all investment profits to the portfolio. This simple discipline allows you to enjoy your life today without undermining the steady long-term growth of your wealth. 3. Calculate the specific difference, using your own numbers, between reinvesting and withdrawing profits over a 20 to 30-year horizon. Run the figures through an online calculator. This concrete picture will become your most powerful personal motivator whenever the temptation arises to take money out and spend it. 4. If you feel a genuine psychological need to see tangible results from your investments, allow yourself to reinvest 90% of the profit and spend 10%. This is a reasonable compromise that preserves most of the power of compounding while providing a real and visible reward for discipline and patience. 5. Think of every reinvested dollar as hiring a new employee into your personal service. This employee works around the clock every day of the year with no days off. They generate income that hires the next employee. Over time, that workforce grows large enough to support you entirely without additional effort on your part. 6. Hold to the reinvestment principle with particular firmness during rising markets. That is precisely when the temptation to lock in profits and spend them is strongest. But a rising market is the worst moment to withdraw funds. Let profits keep compounding when the mechanism is running at its greatest speed. Common mistake. People treat investment profit as money that is rightfully theirs to spend immediately. I have already done the work of investing. Now I can enjoy the reward. But profit withdrawn today costs far more than it appears, because with it goes all the future income that money would have generated over the coming decades. Every dollar of profit spent today represents several dollars irretrievably lost in the future. Result: let your money do the work instead of you. Reinvest profits consistently and patiently, and one day your capital will sustain any lifestyle you want entirely on its own. Part 6. The Values of True Wealth. Rule 26. Wealth is not income. It's freedom of choice. The rule: a wealthy person is not the one who earns the most. A wealthy person is the one who can stop working and continue living exactly as they wish. Income without freedom is gilded chains, gleaming on the outside, but no less heavy than ordinary ones. Real wealth is not measured by the size of a salary, the value of a car, or the square footage of an apartment. It is measured by the number of days you can live without selling your time, and by how wide your genuine choices are at every moment of your life. Why it works. Most people considered successful are, in reality, deeply financially dependent. They earn a great deal and spend the same amount or more. Their lifestyle requires a constant high income with no right to pause. If they lost their job tomorrow, within a few months, they would have to accept any terms just to restore the cash flow. That is not freedom. It is a costly, exhausting dependency dressed up in a very attractive window display. True wealth looks different. It is the point at which your assets generate enough income to cover all your expenses. income that exists entirely independently of whether you are working today or not. This means you can choose work, not because it pays well, but because you genuinely enjoy it. You can walk away from a bad deal without fear. You can take a break, change direction, or try something new, because your well-being does not depend on an immediate result. That freedom of choice is what real wealth actually means. This is why the right question on the path to financial independence is not how much do I earn, but how long can I live without working while fully maintaining my current lifestyle? The second question measures real wealth, the store of financial freedom you have built. The first measures only the speed of incoming cash, which can stop at any moment without warning. What to do and how to apply it. 1. Calculate your current financial independence number right now. Divide the total value of your liquid assets by your monthly expenses. The result is the number of months you can live without working. If that number is below 12, your financial freedom is critically thin. Above 360, you are financially independent. Knowing where you stand is the starting point for any serious financial strategy. 2. Shift your thinking from how do I earn more to how do I create assets that earn on my behalf. This does not mean abandoning active income. It matters, especially during the accumulation phase. But the ultimate goal is building passive income sources that operate independently of you. 3. Consistently reduce your expenses as a proportion of income. The less your lifestyle costs, the faster you reach financial independence, and the smaller the passive income you need to sustain it. A lean, intentional lifestyle is not poverty. It is a deliberate choice of freedom over costly status. 4. Build multiple passive income streams alongside your primary work. A dividend portfolio, rental income, royalties, a business run by a hired manager. Each new stream is another step toward genuine financial freedom. Diversifying income sources is just as important as diversifying an investment portfolio. 5. Evaluate every major financial decision through the lens of freedom, not status. Buying an expensive car on credit reduces your freedom. It raises fixed expenses and extends the road to independence. Investing the same sum in income-generating assets increases it. Always ask, does this decision bring me closer to freedom or push me further away? 6. Define your own specific number for financial independence, a concrete asset total or passive income level at which you are no longer dependent on selling your time. Write it down and break it into intermediate milestones. A concrete goal turns financial independence from an abstract dream into a real, manageable project. Common mistake. People mistake high income for wealth and immediately begin spending accordingly. Every pay rise brings more expensive housing, a more expensive car, a more expensive vacation. The result is that dependence on income does not shrink. It grows right along with earnings. This is the gilded chains trap, and thousands of highly paid professionals fall into it. High income is a tool for building wealth. It is not wealth itself. Result: aim not for high income, but for financial freedom. Build assets that work in your place, and one day you will wake up every morning with the full right to choose how to spend that day. Rule 27. Simplicity beats complexity. Avoid schemes you don't understand. The rule. In investing and finance, complexity is almost never your friend. Complex financial products, convoluted structures, multi-layered instruments that require specialist knowledge just to begin to understand. These generally serve one primary purpose: to enrich those who create them, not those who invest in them. If you cannot explain the essence of an investment in 2 minutes in plain language, that is not a sign of its depth or sophistication. It is a red flag that demands serious caution. Why it works. Financial history shows repeatedly that complex and opaque instruments lie behind most major crises. The 2008 mortgage meltdown was built on derivatives so bewilderingly complicated that even their creators did not fully understand the risks involved. Across financial scandals, Ponzi schemes, and investment frauds, one thread is constant. They always hide behind a wall of complexity. When someone tells you, "This is too complex to explain," either they do not understand what they are offering, or they do not want you to understand it. In either case, walk away. Simple investment strategies work because they are transparent. When you understand what is making your money grow, you can make clear-headed decisions in any market. You know what to hold when everything is falling. You know when to sell and when to buy more. Understanding is your protection. Complexity is someone else's protection against your understanding. Complex financial products also almost always carry hidden costs, high management fees, restrictive exit conditions, early withdrawal penalties, and opaque pricing. These costs are nearly invisible at the point of entry, but erode real returns significantly over time. Simple instruments, index funds, shares in quality companies, bonds, are transparent in their costs and predictable in their logic. They form the core of most genuinely successful investors' portfolios. What to do and how to apply it. 1. Apply the 2-minute explanation rule before every investment. If you cannot explain in plain language how the instrument makes money, where the return comes from, and what the main risks are, do not invest. This rule alone filters out the vast majority of potentially dangerous and opaque schemes before they can do real damage to your capital. 2. Always establish the full cost structure of any financial product before committing. Management fees, performance fees, spreads, tax implications, exit penalties. All of it must be clear before any decision is made. A difference of 1 to 2% in annual fees compounds into enormous sums over a long horizon. 3. Treat any proposal guaranteeing high returns with minimal risk with consistent, deep skepticism. That combination does not exist in the real financial world. If someone is offering above-market returns without a convincing explanation of where that return comes from, it is either fraud or well-hidden risk. 4. Build your portfolio on simple, well-understood strategies as an unchanging foundation. Exotic instruments and complex derivatives, if they belong at all, should occupy only a small share, and only if you genuinely understand their full mechanics and associated risks. 5. Ask direct questions and demand direct answers. If a financial advisor deflects, hides behind the product's complexity, or pressures you with time, leave without hesitation. A sound financial instrument can always be explained honestly to any reasonable person. A poor one needs the fog of complexity to survive. 6. Review your portfolio regularly from the standpoint of simplicity and comprehension. If you find instruments whose workings are no longer entirely clear to you, or which you acquired on someone else's advice without real understanding, consider replacing them with more transparent equivalents. Knowing what you own is an ongoing obligation, not a one-time exercise. Common mistake. People equate complexity with expertise. They reason, if it's this complicated, there must be smart, experienced people behind it who really understand the market. In reality, complexity often masks either incompetence or the deliberate concealment of unfavorable terms. Smart money consistently seeks simplicity and transparency. Complexity is created for those who are meant to be confused. Result: the most effective investment strategies in history are remarkably simple. Buy quality assets at reasonable prices and hold them for a long time. Everything else is noise, and your portfolio only suffers from it. Rule 28. Don't compare yourself to others. Play your own game. The rule, comparing yourself to others in finance and in life, almost always leads to one of two places: envy that drives unreasonable decisions, or complacency that stops further growth. The only comparison that carries real meaning is between who you are today and who you were yesterday. Your financial path is unique. You have your own starting point, your own obligations, your own risk tolerance, and your own priorities. Stop playing someone else's game, and you can finally start winning your own. Why it works. When you look at other people's financial success, you almost never see the full picture. You see the car, not the loan. You see the vacation, not the empty investment account. You see the impressive portfolio return from last year, not the risks taken to achieve it, or how the story ends. Social media has created the illusion that everyone around you is getting richer, faster, and better than you. It is a carefully curated shop window with nothing visible behind it. The truth is always significantly more complicated. Comparison is especially dangerous in investing. When a neighbor describes doubling his money on a speculative bet, the temptation to copy him is real and hard to resist. But you do not know about his losses. You do not know the financial cushion that allows him to take risks you cannot. You do not know his investment horizon or his actual tolerance for a serious downturn. Copying someone else's strategy without understanding their context is a direct path to losses you cannot afford, chasing gains you do not need right now. Every person has their own financial game. Yours is defined by your specific goals, your time horizon, and the risks you can sustain, not just mathematically, but psychologically. The game of a 30-year-old entrepreneur without dependents is fundamentally different from that of a 45-year-old with a mortgage and 2 children. Winning your own game matters far more than any position in someone else's ranking. What to do and how to apply it. 1. Define your personal financial goals and write them down specifically and measurably. Not become wealthy, but accumulate 3 million rubles by age 50 to generate passive income. Once you have a concrete personal target, comparison with others loses its grip. You are measuring progress against your own destination, not someone else's results. 2. Keep a personal financial journal and review your progress quarterly across 3 measures: growth of net assets, progress toward financial independence, and level of financial literacy. These 3 indicators tell you far more about real forward movement than any comparison with others ever will. 3. Deliberately limit your exposure to content that provokes financial comparison. Social media, built around displaying purchases and investment wins, systematically distorts the financial reality of most people. Less time on comparison means more time on your own progress. 4. Build your investment strategy around your own profile: age, time horizon, capital, risk tolerance, financial obligations, and psychological resilience to volatility. The right strategy is the one you can actually follow over the long term, not the one that produced an impressive result for someone else last year. 5. When you hear about exceptional financial results achieved by another person, ask yourself honestly, do I know the full picture? All the risks, all the losses, all the circumstances? In most cases, you know only the surface. The full story almost always looks very different. 6. Mark every piece of your own financial progress, including the small ones. The first month with positive savings, the first 100,000 in an investment account, the first year without consumer debt. These milestones matter more than anyone else's results, because they are the ones building your specific future. Common mistake. People adopt others' financial decisions as benchmarks for their own, without accounting for the fundamental differences in context, goals, and circumstances. The result? They take on unsuitable risks, buy unsuitable assets, and maintain a lifestyle that was never genuinely their own choice. That is someone else's game, played with your money. And in it, you inevitably lose, even when it looks like you are winning. Result: your financial path is yours alone. Compare yourself only with yesterday's version of yourself. Move toward your goals at your own pace. And it is that movement, in the end, that will prove to be your real victory. Rule 29. Money is a tool, not the goal of life. The rule. Money has a unique and insidious ability to shift from being a means to being an end. And that moment of transformation is one of the most dangerous in anyone's life. When accumulating money becomes the point in itself, it begins to manage you rather than the other way around. Money is an instrument, a tool for creating security, expanding possibilities, securing freedom, supporting the people you love, and contributing to what matters to you. But no instrument is the meaning of life. You create the meaning. Money simply helps bring it into reality. Why it works. History offers countless examples of people who reached great financial heights, only to find that money alone had not delivered what they expected. They solved the problem of survival, but not the problem of meaning. They bought freedom from compulsion, but not joy. They secured safety, but not satisfaction. By contrast, people who had a clear sense of why they were earning and accumulating used money as a powerful instrument for building a life that gave them genuine meaning and satisfaction every day. Knowing why you need money changes your entire financial strategy. When you have concrete answers to the questions, what for and for whom, financial decisions become far clearer and more purposeful. You stop spending on things that do not align with your real values. You stop chasing income for its own sake. You start making decisions that answer not, how do I earn more, but how do I build the life I actually want? That is a different level of financial and personal thinking, and it produces very different results. Money also does not replace what genuinely creates happiness and meaning: deep relationships, health, the use of one's abilities, contribution to others' lives. Research in the psychology of happiness has confirmed repeatedly that beyond the income level providing comfort and security, further earnings no longer correlate directly with life satisfaction. This does not mean money is unimportant. It means money is necessary, but not sufficient for a full life. What to do and how to apply it. 1. Write down a concrete answer to this question. What exactly do you need money for? Not in abstract terms, security or freedom, but specifically and personally. Financial independence by 50, in order to spend the second half of life doing work you love without financial pressure. Your children's education, the ability to help your parents. Concrete answers transform money from an end into a tool with a clear purpose. 2. At least once a year, revisit your life priorities and check whether your financial strategy still reflects them. Values shift over time. Strategy should shift with them. Money working toward outdated goals is not working toward your real life. 3. Spend consciously on experiences and relationships, not only on things. Research in the psychology of happiness consistently shows that spending on experiences, travel, learning, time with the people who matter, produces more lasting satisfaction than spending on material objects. Spend in ways that align with what genuinely matters to you. 4. Include generosity in your financial strategy as a planned budget item, not an occasional impulse. Helping others, charitable giving, supporting loved ones, investing in your community, creates a sense of meaning and contribution that adds more to your well-being than equivalent spending on yourself. 5. Practice noticing and appreciating what you already have. Gratitude is not merely a pleasing idea. It is a psychologically proven instrument for raising subjective well-being. A person acting from a sense of sufficiency makes more grounded financial decisions because their motivation comes from fullness rather than lack. 6. Remember, money is a means, not a measure of your worth. Your significance, your contribution to the world, your relationships, and your character are not defined by the size of your capital. Money creates possibilities. What you do with those possibilities is determined entirely by your own choices. Common mistake. People postpone living until the moment when they have enough money. They tell themselves, once I have saved a certain amount, I will start living the way I want. But that moment rarely arrives because the bar of enough rises along with the capital. Life is happening now. Money should serve that life, not hold its place while you wait for some ideal future moment. Result: use money as a tool for building a life filled with meaning, freedom, and genuine satisfaction. The tool is not the goal is the life it helps create. Rule 30. Be grateful and generous. Wealth obliges you to share. The rule: true wealth is measured not only by how much you have accumulated, but by how much you give away consciously and willingly. Generosity is not the opposite of wealth. It is wealth's natural continuation. A person who has built significant capital but shares nothing has created numbers but not meaning. Gratitude and generosity are not weakness or extravagance. They are the mark of someone who has genuinely understood the nature of wealth and found a way to make it matter. Why it works. Research in psychology and behavioral economics has repeatedly confirmed a counterintuitive finding. People who actively give feel wealthier than those who only accumulate, even with objectively less capital. This happens for several reasons. Generosity activates the brain's reward circuitry. It creates a sense of abundance and inner sufficiency, in contrast to the persistent fear of scarcity that characterizes a scarcity mindset. It strengthens social bonds and reputation, which are concrete and valuable economic assets in real life. Gratitude works through a similar mechanism. When you regularly notice and acknowledge what you already have, your mind shifts from a mode of perpetual deficit to one of genuine abundance. This is not a metaphor. It is a real, measurable neuropsychological shift. A person who perceives their life as already rich makes fundamentally different financial decisions from one who chronically feels lack. They do not spend compulsively to fill an inner void. They do not take reckless risks in pursuit of more. They act from a place of calm sufficiency. And that is the ideal foundation for rational, long-term financial thinking. Generosity also has tangible practical consequences. People who help others freely, sharing knowledge, time, resources, and opportunities, build around themselves a network of goodwill and mutual support. That network returns to them in the form of new opportunities, valuable relationships, and real assistance in difficult moments. Generosity is a smart, long-term investment in social capital, whose returns often exceed those of financial investments. What to do and how to apply it. 1. Include charitable giving as a fixed line item in your personal budget. It might be 1% of income or 5%. The amount matters less than the principle. Generosity as a consistent practice, not an occasional impulse. When giving becomes a stable habit, it becomes a reliable source of meaning and satisfaction. 2. Make daily gratitude a concrete morning or evening ritual. Write down 3 things you are grateful for today. They can be large or small, obvious or subtle. After several weeks of regular practice, you will notice a genuine shift in how you see your life and your financial situation. 3. Share knowledge and experience as generously as you share money. Time spent mentoring, offering advice, or helping someone work through a financial question is a contribution that creates real value beyond your personal capital. Financial literacy shared with others changes lives, and that may be the best return available to anyone, regardless of their capital. 5. Help the people in your immediate circle, family, friends, colleagues, not necessarily with money. Useful introductions, the right advice, opening a door to an opportunity. These are equally valid forms of generosity that often matter more than financial transfers and require no significant capital at all. 6. When you achieve financial success, honestly acknowledge the role of luck, circumstances, and the people who helped you. This does not diminish your personal effort. It is a sign of genuine maturity. Recognizing others' contribution to your path is itself a form of generosity, one that strengthens relationships and earns lasting respect. Keep in mind, regularly, those who have had less good fortune than you, not from guilt, but from a clear-eyed appreciation of your own luck. That understanding sustains genuine, unpretentious generosity, the kind that changes others' lives and gives your own a depth no balance sheet can provide. Common mistake. People tell themselves they will start giving once they have accumulated enough. But that moment never arrives, because the bar of enough rises with the capital. Generosity is not the result of wealth. It is one of its causes. People who give from the beginning of their path develop a psychology of abundance that accelerates accumulation. Start giving today, in whatever amount and whatever form you can. Result: wealth kept entirely to yourself is just a number on a screen. Wealth shared becomes a legacy that outlives you. Be grateful for what you have and generous in what you give, and your life will hold a meaning no account balance can replace. Conclusion. These 30 rules are the distilled essence of everything Warren Buffett taught over 7 decades of an extraordinary life. What you have before you is not abstract theory or a wish list of aspirations. It is a verified, time-tested system of thinking and action, one that works for any person, regardless of starting capital, age, or circumstances. Return to these rules. Notice how simple they are at their core, and how rarely people actually follow them. Buy what you understand. Protect capital. Think long-term. Manage your emotions. Live below your means. Invest in yourself. Keep learning. These are not secrets reserved for the privileged few. They are principles available to everyone, including you. You do not need to apply all 30 rules at once. Start with one. Choose the rule that resonates most with you right now, and act on it today. Open an investment account. Pay off one debt. Read the first page of a book you have been putting off. Set aside the first amount, even a very modest one. Take one concrete step, and that step will set in motion a chain of changes you cannot yet imagine. Many people read books about finance and investing, and do nothing. They wait for the perfect moment, the right conditions, enough income, complete readiness. But the perfect moment does not exist. Only this moment exists, right now. And what you do with it will shape your financial future 10, 20, and 30 years from now. Wealth does not arrive suddenly. It is built day by day, decision by decision, habit by habit. That is Buffett's central lesson. Not genius, not luck, not connections produce outstanding results. What produces them is consistency, calm, patient, unwavering consistency in the right actions over a long period of time. Compound interest works not only with money, it works with habits, knowledge, reputation, and character. Every day you act well strengthens the result of every day that came before. The path to financial freedom is not a sprint. It is a marathon run with a compass rather than a stopwatch. Your task is not to come first in someone else's race, but to reach your own goal at your own pace, without unnecessary urgency, without watching those running beside you, with a clear sense of where you are going and why. These 30 rules are your compass. Return to them again and again. Reread them in moments of doubt. Apply them in moments of choice. Let them become part of how you think. And one day, you will find that you see money, time, and life in a fundamentally different way than before. Not because you read a worthwhile book, but because you began living by its principles every day. Your path to financial freedom begins right now. If you enjoyed this book, take a look at the other titles in the Golden Rules series. Here we have gathered the key ideas from bestsellers, just for you.
Thank you for listening until the very end. If you enjoyed this audiobook, support the video with a like and subscribe to the channel so you don't miss new releases.